There we go. All right. So remember, the course we're going to take today is Virginia Health. Virginia Health Pre-Licensing, not Life and Health. Virginia Health Pre-Licensing. But we're using this material because we're not going to waste paper and throw everything away and start over with the material you have. We're going to go through this. You'll see how as it works forward. Once again, your test is a 100 question test. 70% is a passing score, not rocket science. I promise you, if you prepare like I suggest, you'll pass this test the first time. Again, licensed coach, I just went through the process of how to get that done. If you have any questions or problems, call me. But we're going to start out with definitions. So if you'll go to your the PowerPoint presentation you have, which is almost identical to what I have, where it says preliminary definitions, it should be right in the front. At the top of the page, it's going to talk about insurance, and we're going to define insurance. So insurance is defined as the transfer of risk. We give an insurance company a certain amount of money on a regular basis. That's called premium. And in exchange, the insurance company makes us a promise. And that promise is to indemnify us or to restore us financially to the position we were in prior to the loss. Okay, so insurance is the transfer of risk. If we don't have the insurance, we have to assume the consequences of any losses from the risks that occur to us. Insurance is not the elimination of risk. They do try to get tricky on the test and try to confuse you. So it's got nothing to do with eliminating risk. It'd be really nice if I could tell somebody, buy this health insurance policy from me, you'll never get sick. Boy, that'd be great, wouldn't it? Sell a whole lot of health insurance, wouldn't get any arguments from anybody. Price wouldn't matter. But we can't promise them that, can we? We can only promise them that if they do get sick or hurt, need medical care, we have a product that'll help them finance that, help them pay those bills. Now, let's talk about risk. There's two kinds of risk. Pure risk and speculative risk. And you can see the definition between the two. They're different, aren't they? Pure risk is a chance of loss, but no chance for gain. Speculative risk, yeah, a chance of loss, but also a chance for gain. Insurance only will insure what are referred to as pure risk. Pure risk. Insurance is not meant for a person to make a profit. It's only meant to indemnify. To indemnify. Matter of fact, bear with me while I do this. Hold on. I should have had this ready, but I messed up. There we go. Bear with me while I get this. Here it comes. Okay. All right. Let's make it a little bit bigger. Okay. Indemnify. Indemnify means to restore or make whole again financially. That's the word. That's what indemnify is. And to indemnify, or the principle of indemnity, is an underlying tenet of insurance. That's why it exists. It exists to indemnify. That's the principle of indemnity, to restore, not to make a profit. There we go. Okay. So pure risk is a risk where you get indemnified. Pure risk is the kind of risk where there's a chance of loss, no chance of gain. Gambling is a speculative risk. Insurance companies will not insure your trip to Las Vegas or Atlantic City. Yeah, you can lose, but you also could win. And because of the potential to win, insurance companies are not going to do that. Okay, that's called a speculative risk, not involved. So true or false? Only pure risks are insurable. What do you think? You don't have to shout out an answer. Just formulate one in your head. Answer is, that's true. Only pure risks are insurable. But, however, not all pure risks will be able to get insurance. Not everybody who wants insurance is going to be able to get it. There are some people that are just uninsurable. Now, since the advent of the Affordable Care Act, the concept of pre-existing conditions and uninsurability has pretty much gone out the window. But the test doesn't ask questions thinking that the Affordable Care Act even exists. So whatever you think you know, whatever you may know, relative to the Affordable Care Act, is not going to help you on this test. Don't shoot the messenger. I'm just telling you the fact. So, some risks are uninsurable, even in health insurance. Let's get a couple of more definitions out of the way. Hazards. Hazards increase the possibility of loss. That's what a hazard is. There are basically 4 of them. Let's make sure we understand. Physical hazard, one you can touch, taste, smell, or feel. It's real. So poor health is a physical hazard. Bald tires on a car. An oily rag up against a hot water heater. A house next to an ammunition factory. Those are physical hazards. They increase the possibility that your house is going to disappear on some days and some dude lights up a cigarette in the middle of the ammunition factory, okay? So, what we're worried about, obviously, is poor health. People with poor health pose a greater risk to the insurance company. And the worse, that's a poor choice of words. The least healthy you are, the greater chance of getting sick or ill, and insurance companies want to charge more money for that. We have moral hazards. Moral hazard. What does somebody's morals have to do with insurance? Why do insurance companies give a rap what my morals are? Well, I tell you what, it means a lot to them because they want to know who they are doing business with. What kind of person are they doing business with? They don't want to do business with someone who might lie on an application just to get a policy issued. That's not going to go. That's not going to fly. They want to make sure people have at least good character. Now, my personal definition of a moral hazard is someone I wouldn't leave my spouse, my wallet, or my children with for any length of time. These are just not nice people. But somebody who might lie in an application just to get a policy issued is also a measure of somebody's character. So that's a moral hazard. We also have to deal with another possibility when it comes to hazards in the sense that we have what are called morale hazard. And a morale hazard has more to do with somebody's attitude than with their character. Let's assume that we are all an insurance company, we're an auto insurance company, and we get an application from somebody who wants to insure their car for liability and comp and collision, which would include theft. And we investigate this person because we will investigate them. We want to know who they are. They're asking us to put our money on the line based upon a little bit of money they give us. So we want to know who we're doing business with. So we find out this person never takes the keys from their ignition when they park the car. As a matter of fact, they even leave the doors unlocked. They just never bother locking the doors or taking the keys with them. Well, I can promise you, if you think it over, you wouldn't want to insure this guy's car for theft. Not because he's a bad person, but because his attitude is probably, what do I care if they steal my car? I got insurance. Well, moral hazard. Got it? More about more about attitude. Then we have a legal hazard. This doesn't affect us in our world, but you should know it. A legal hazard is the potential to get sued, which is why we have liability insurance, which is why if you own a home, you have liability insurance in case somebody gets hurt on your property. Or if you own a car, driving a car, you should have liability insurance in case you hurt somebody or damage somebody else's property where you become liable for their damages. So rather than you foot the bill when you get sued for $100,000 because you hurt somebody, your insurance company, you transfer that risk to the insurance company. So the potential to be sued is a legal hazard. That is not an issue for our test, but you might as well know it. It wouldn't hurt. So we need to focus on 3 hazards: physical, moral, and morale. And also, I don't want to insult your intelligence. However, there is a difference between those words, but it's subtle, isn't it? The letter E makes a difference. And this did not show up on the last test I took, but it has shown up on prior tests where they ask a question about moral hazard and they give me 4 choices. So I select the one that I think is correct. Usually deals with somebody's character. Later in the test, they asked me another question about moral hazard, and they have me give me the same 4 choices, hoping that I misread the question because one letter makes a difference, doesn't it? And by the time I got to that question, they were hoping that I got all bleary-eyed and tired and that I might have misread the question. So that's my point. Just be aware. So hazards increase the possibility of loss. Now, let's talk about what causes losses. Well, those are perils. Now, as I said, I'm from New Jersey, and perils are things ladies wear around their neck, perils and poils. We're not talking about that here. We're talking about insurance perils, which are events of life that can cause a financial loss. Death, sickness, injury, fire, robbery, issues like that. When they occur, somebody's having a financial loss. Our particular course is going to talk about the losses caused by sickness and injury. We do have one product that deals with death. We'll talk about that as we go along, but we're not dealing with the others, okay? It's just death, sickness, and injury, primarily sickness and injury. So keep straight. Hazards increase the possibility of loss, but perils cause losses. I want to talk a little bit about the relationships in an insurance contract. And I'm going to use life insurance as the example because it does make it it makes it easier to explain, but this is true for life or health. So we have an insurer, that's the company, and their function here is to make a promise. They make a promise to what? Indemnify us if a loss occurs under the terms of that contract. The insured, talk about reading properly, huh? The insured, the contract is based upon the life or health of that person. There's an owner. All insurance policies have owners. So the owner has all the rights. And one of those rights is to name the beneficiary, which we're going to talk about. Then we have a premium payer. And the premium payer is the individual or entity that has assumed the responsibility to make the premium payments. We have a beneficiary. And the beneficiary is the person that the owner selects who will receive the proceeds, if there are any, when the insured dies. The beneficiary is named by the owner to receive the death benefit when the insured dies. Now, there are some health contracts that provide a death benefit. So in that policy, the owner would have named who the beneficiary is. And then we have an applicant, and the applicant is the person who answers the questions on the application. I don't know if you can, you probably have taken out a policy of insurance somewhere along the line, but you may not have picked up on this, but I promise you from now on you will. The questions are written from what I refer to as third person. They don't ask, have you ever? They ask, has any proposed insured ever? Or in the last 5 years, has any proposed insured? They always ask it from some other point of view, meaning, my point here is that anyone could answer that question based upon the knowledge they have about that proposed insured. So that's why we have an applicant who could be the insured or the owner or not. We'll talk about that. So normally, the insured, the owner, the premium payer, and the applicant, same person. We generally buy, own, and pay the premium on our own insurance policies. But what I need you to understand and get here is that it doesn't always have to be that way. There are circumstances where the owner and the insured are two different people. That's why the insured should be showing up as green on the screen, but the owner, premium payer, and applicant are still in red. See, if they are different, if the owner and the insured are different, then the owner must have what's called insurable interest in the life or health of the insured at the time the policy was applied for. Please underline the word time of application. Those words, time of application, that's an important time. When does insurable interest have to exist between the owner and the insured? At the time the policy's applied for, not at the time of the loss, not when the loss occurs, not when the policy is issued. Those are different points in time. Insurable interest, that unique relationship between the owner and the insured, must be there only at the time the policy is applied for. It doesn't ever have to exist from that day forward. So understand the relationships here as best as possible. Let's talk about insurable interest. It is assumed that we have an unlimited insurable interest in our own lives. Unlimited insurable interest in our own lives. Now, monetary relationships create insurable interest. If we were partners in a business, we would have insurable interest in each other because of the fact that if something happened to one of us, either physically or if we died, one of us got disabled or died, then the remaining partners might suffer a financial loss. So we have, because of that relationship and the potential for financial loss, we have insurable interest in each other. Banks have insurable interest in borrowers. When a bank lends us money to buy a car or buy a house, they want to make sure that there's insurance in place in case we wreck the car, or if the house is damaged or burns down, there's money that will help rebuild the house or fix the car. They're not going to count on us to do that. We just walk away from it. They got more invested in the house or car than we do. So as a result of that relationship, the fact that they have money on the hook, they have insurable interest in that auto or that vehicle. Be careful. Borrowers do not have insurable interest in lenders. Okay, the lender goes out of business, the borrower is going to be happier because there's a good chance he may not have to pay the loan. Okay. The other way, the more common way relationships created insurable interest is what's called strong love and affection generated by blood or marriage. So that would include what? Spouses, and parents and children. It generally doesn't go beyond immediate family. That the test doesn't drill down that deeply into this. I'm just letting you know. It generally doesn't go beyond immediate family. But surely moms and dads have insurable interest in their children, and so do children in their parents. And spouses have insurable interest in each other. Okay. And marriage is defined as what's legal in that state as a marriage. If whatever that state says is a legal union, then it's legal. And once again, insurable interest only needs to exist at what time? At the time of the application. Period. End of story. And that we've already been through this a little bit. That third-party owner, that's when the owner and the insured are not the same person. So who are the parties? I said third party. There's three parties. Who are they? Who are those three parties? Well, remember we have, let me do this. We have the insurer, that's one party. We have the insured, that's the second party. And then we have an owner. That's the third party. So the insurer, the insured, and the owner are the three parties. And as we said just a few minutes ago, usually the insured and the owner are the same person, but they don't have to be. So when the insured and the owner are not the same person, that's referred to as third-party ownership. And as I said, that person must have insurable interest in the insured when? At the time of application. So here's a typical question you may get. If the owner and the insured are two different people, which of the following would be a primary concern for the home office underwriter? I'm not going to ask you to shout out an answer. I just want you to take a second or two and look at those choices and mentally come up with what you think should be the answer. And then I'm going to tell you what the answer is. If you guess C, you'd be correct. The relationship between the insured and the owner is the concern. Does the owner have insurable interest in the life or health of the insured? I hope that makes sense to you. Now, how do insurance companies know how much to charge us for the insurance they're selling us, for the risks they're taking, and still manage to pay claims and make a profit, because I promise you, they're there to make a profit, okay, and pay their bills. Well, they utilize what's called the law of large numbers. The law of large numbers. Matter of fact, what I'd like you to do is jot this down. The law of large numbers. Oops. The larger the number, the easier to predict. I'm a pretty good speller. I'm a terrible typist, you're going to find as we go forth through it. But if you've ever taken a course in statistics or analytics, that might be familiar to you. Whenever we're trying to determine what an outcome's going to be statistically, the more data and accurate information we have going into the equation, the more accurate our answer is going to be on the other side. So the shorthand definition of the law of large numbers is the larger the number, the easier to predict. So just jot that down if you don't mind. Might be helpful to you. So in health insurance, they use what are called morbidity tables. Well, how do they get them? Where do they come from? Before we go there, let's read the definition. Morbidity tables predict the incidence of sickness and or injury among a large number of similar risks over time. That's your definition of health insurance. Morbidity tables. I'm sorry, I misspoke there. The definition of health insurance morbidity tables, the use of the law of large numbers, the use of the law of large numbers. Now, I'm obliged to go over this with you. On your slides, your slides on page 2, down at the bottom, there's where it says key concepts. You can skip that. You can ignore it. Okay? You can ignore it. And we're kind of a little bit out of sequence, but I promise you it'll come back together. But that particular slide is not that critical for you. So the law of large numbers. No big deal. Okay. So how do they get those numbers? Well, there's employees of insurance companies. They're referred to as actuaries. Actuaries. These are what I refer to as number crunchers. I mean, they don't have a crystal ball that looks into the future, but they can go into the past. Let's say go back to 1990, and they can look at the statistics of what actually occurred in 1990, where they look at the statistics among millions of people of a specific age and gender. They put them in classes. They classify them by age and gender and certain health characteristics. And how many of those people who started out the year experience some form of health insurance problem during the year, and how much it costs to get that fixed or it costs to take care of it. So they can run those numbers from 1990 to determine the costs it'd take to cover it today. They extrapolate that into what are called morbidity tables. You don't need to know exactly how, but it doesn't hurt for you to get an idea. They don't use crystal ball. The morbidity tables are what insurance companies use. In life insurance, just as an aside, they call them mortality tables. In health insurance, they call them morbidity tables. Yeah, this is a slide. I said skip it, but maybe we're going to go through it. Let's go through it, and we'll take care of something. So, an insurance contract. Let's talk about some key concepts here. I told you we'd be a little bit rough this morning because we made some changes, so just hang in there with us. An insurance policy is a contract between the insurer and the owner. Now, it says while the insured lives. That would be for life insurance. That's also true for health insurance, okay? Because when a person who has a health insurance policy dies, that health insurance contract is done, okay? So we understand that's a contract between the owner and the insurer for the life of while the insured is alive, and for as long as, by the way, the policy is in force. The premium has to be paid to keep the policy in force. I would hope common sense would take you to that understanding. So who is the insured? Remember, the insured, the policy is based upon that person. The insurer makes a promise. So here, life insurance, forget this part. You can ignore the part about life insurance. Forget it. Only thing I want you to focus on again, the beneficiary is the person that's named by the owner. They get any money that may come out. The owner has all the rights and privileges. And remember, ladies and gentlemen, that owner does not have to be the insured. Keep that in mind. So you have to read the question carefully. Premium. Premium is what we pay. Now, on your slide, on your copy of the page, I would suggest you cross off the word mortality and replace it with the word morbidity. Take the word mortality and replace it with the word morbidity. Because the premium that we pay for health insurance has three factors that make it what it is. Morbidity, which we already defined a minute ago. Expenses, you might also add the word load, because the word expense and or load are interchangeable. That's what it costs a company to stay in business. They have to pay bills. That money doesn't come from a tree in the backyard of the insurance company. It comes from the premium the insureds pay. And then when the insurance company gets money, they can invest it. And they take some of the earnings that they acquire from investments and they apply it to premium. We call it interest. So the mortality and expense, I want you to get this part. So if you have a question, you ask me. So the mortality and the expense portion of the premium make the premium go up. Because, I'm sorry, the morbidity and expense. Both are the same. They're both the same in the sense it causes the premium to go up. Because as we get older, the greater chance to become sick and hurt. So that causes the premium to go up. As we get older, morbidity rises. So that's going to be a higher cost. And expenses are a cost. But interest is what insurance companies will apply some of the earnings they make on their investments to the premium to help reduce that premium to some extent so they can be more competitive in the marketplace. Because all insurance companies use the same morbidity tables. And the expenses among most insurance companies are pretty similar. And then one of the major differences between, not the only difference, but one of the differences among insurance companies' differences in premium has to do with how much of the earnings that they have are they willing to apply to premium to get that premium reduced. It's all about staying competitive in the marketplace. More than you need to know for the test. But what I do need you to remember is there are three things that make up premium: morbidity, interest, and expense. Morbidity and expense have a tendency to drive it up, and interest has a tendency to drive that premium down. Let's talk about types of insurers. Types of insurers. Insurance companies are identified a number of different ways. One of the ways they identify insurers is where were they formed? Where were they created? Let me go to my little worksheet here. There are approximately 55 jurisdictions. These are legal jurisdictions. And each of these jurisdictions has a organization referred to as the board, I'm sorry, not board of, Department of Insurance. Or it might also be called the Bureau of Insurance. Same thing. So there are 50 jurisdictions. Each has their own Department or Bureau of Insurance. We're going to be talking about that later. But I want you to kind of get this point. And most of, okay, now what are those jurisdictions? 50 of them are the states of the U.S. 50 states plus D.C. Whoops, those are commas. I should put periods. D.C., that's a jurisdiction. Puerto Rico, I just abbreviated Puerto Rico. Guam, the Virgin Islands, and there's probably one or two others out there. It doesn't matter. You don't need to know the exact number. I'm just trying to make a point to you. And the point is, insurance is regulated primarily we use the word state or jurisdiction interchangeably. The word state on your test, the word state and jurisdiction are interchangeable. Okay? Come on. The word state and jurisdiction are interchangeable. So try to be more clear here, the state, each state is the primary regulator of insurance. Each state is the primary regulator. The feds are not the primary regulator of insurance, but the states are. We're going to talk more about that later. So when we talk about types of insurers, one of the things we have to discuss is, okay, so how do I identify companies? We identify companies by, number one, where were they formed? What jurisdiction were they formed in? So companies that are referred to as domestic are doing business in the legal jurisdiction in which they were formed. So if we wanted to form an insurance company, let's say here in Virginia, Virginia would be our domicile. That would be domestic to Virginia. If we chose to, we could want to expand our operations to, say, North Carolina or California or New Jersey or wherever in the jurisdictions that we're talking about. If we wanted to do that, we can. But in those jurisdictions, we refer to as a foreign insurance company, because now we're doing business in a state other than our home state. So don't fall into the trap of when you see the word foreign, think of Europe. No, foreign in this usage is another jurisdiction or state. We'd have to be approved to do business in that state, but we'd be considered foreign insurer rather than a domestic insurer there. Now, alien doesn't mean Pluto or Mars. Alien is referring to what you might think about when you think of foreign. It's another country, okay? So if we have a company that's called Sun Life of Canada, we could pretty much guess that might be a Canadian company. If they're doing business in Virginia, we're going to refer to them as an alien insurance company. That's the way it works. If we form our company here in Virginia, Virginia is our domicile. And if we want to do business in Massachusetts, they're going to refer to us as a foreign company. Has nothing whatever to do with it with anything other than a label, but just recognize the labels and how we come up with them. Stock versus mutual. Another way we identify insurance companies is how they operate financially. What is their financial structure? Some insurance companies are called stock companies, and some insurance companies are called mutual insurance companies. And here's the difference. A stock company has stockholders and is owned by stockholders or shareholders. Why do people buy shares of stock in anything? Well, one of the reasons is hopefully to get dividends, which is a distribution of excess profit from that company. That's one of the reasons why I buy stock, is to get dividends. I'm an owner of the company, and I get to share in the excess profits of that company. That's a dividend from a stock company. It's taxable. And it's not guaranteed, because we can't guarantee profits, so we can't guarantee dividends. Then we have what are called mutual insurance companies. By the way, most insurance companies are stock insurance companies. Most insurance companies are stock insurance companies. Some, not few, but some, more than most people think, are mutual insurance companies. Now, mutual insurance companies don't have don't have stockholders. They have policyholders. Actually, I should use the term policy owner, because when someone buys an insurance policy from a mutual insurance company, they not only own the policy, they own a piece of the company. Some of you may have heard of a company called Prudential. And Prudential has a logo. It's the Rock of Gibraltar. Prudential is currently a stock company. It used to be a mutual company. And I remember clearly that on that logo, at the very bottom of the Rock of Gibraltar, they had a little tagline. And the tagline said, "Own a piece of the rock." What they were trying to convey to people by using that tagline was, we are a mutual company. And if you buy a policy from us, not only will you own that policy and be promised certain benefits if you have a loss under that policy, but you also are going to own a part of our company. We don't have stockholders. We have policy owners who not only own the policy, but own a piece of the company. So we use the phrase, the mutual company is owned mutually by the policy holders or policy owners. Now, don't confuse this with mutual funds. That's an investment vehicle. The word mutual is used a lot in a lot of different venues. This is not an investment, okay? This is a person buys a policy from a mutual company. Mutual companies are referred to as, in the sense that they are owned mutually by the people who buy the policies. Now, the mutual companies also pay dividends to the owners of the company, which has to all happen also be who? The policy owners, right? But these dividends are not taxable. Of course, they can't be guaranteed. So you can see a difference here, huh? The dividend from stock companies are taxable. Dividends from mutual companies are not taxable. I don't know if I mentioned this because I got a good memory, but it's a little short. So I mentioned to you guys that Prudential used to be a mutual company, but they have since demutualized. They are no longer a mutual company. They took the legal steps to become a stock insurance company. They still use the Rock of Gibraltar as their logo, but that little tagline is gone. No longer does it say, own a piece of the company, because you don't get that opportunity just because you buy the policy anymore, okay? The only way you can own a piece of Prudential as an owner of the company is to buy a share of stock. But back to our test. Stock companies pay dividends that are taxable. Mutual companies pay dividends that are not taxable. Why are they not taxable? Well, here's your reason. IRS. I think you're familiar with, we just finished dealing with those guys on the 18th, right? Okay, IRS, most people think it means the Internal Revenue Service. No, it means I'm really sorry, which they're not. Okay, but Internal Revenue Service, they have a rule, and here's a rule. You don't have to have it memorized. You have to understand the concept. Policy dividends from mutual companies, participating policy. Let's stop there for a minute. What do they mean by participating policies? They mean that if you buy an insurance policy from a mutual company, you get to participate in the dividend. So they're just being very specific here. Mutual companies issue insurance policies that are referred to as participating. Policies purchased from stock companies are not. Policies purchased from stock companies are referred to as non-participating policies. Terminology, semantics. So policies purchased from stock insurance companies are called what? Non-participating. Policies bought from mutual companies are called what? Participating. So back to our definition. Policy dividends from mutual companies participating policies are not taxable because they're considered to be a refund. Sometimes it'll say refund of premium, excess premium, or other refund of overcharge. Same idea, refund. When you get a refund, it's your own money. That's not income, therefore it's not taxable. Just a little piece of little nugget you may need to know for the test. Now, there are private insurance and government insurance. Private insurance and government insurance. Private insurance, life insurance, annuities, medical insurance, disability income insurance, all issued by private insurance, one of them the company you're going to go to work with. There's a ton of private insurance companies out there, and they offer all kinds of neat products. And you and I, as producers, can work for them as their agent. It's wonderful. We can earn a living, a good living, help people. What a great concept. We can help people and earn money at the same time. What a concept. Yeah, it's great. But there's also government insurance. Nobody gets any money selling government insurance, or to any great degree anyway. Government insurance, Medicare, Medicaid, and Social Security. We're going to focus a little bit about government insurance right now, just for a little bit, okay? Oh, by the way, just to give you an idea how we're going to work today, we didn't start till about 8:30. I generally want to go about an hour and a half, and then we'll take a break, so we're going to break about 10. If somebody has a real issue and they can't wait till 10, he goes, I'm 77 and I might not be able to wait till 10. Just let me know and we'll take an early break. But I'd like to hang in there till 10 o'clock and we'll take our break then. Okay? So anyway, Medicare, Medicaid, and Social Security, government insurance. Let's talk about it. The questions they ask revolve around 4 topics. Number 1, where does the money come from? How is it funded? And it's more than just taxes. We're going to talk about the specifics in a minute. Who is it for? Who are the specific recipients of these various government insurance programs? And they often refer to them as beneficiaries. Not that somebody died, they just call them beneficiaries. Why does it exist? And then what are the benefits? And we're going to drill down into the benefits a little later in our class. So how is it funded? Let's talk about this first. How is government insurance funded? Well, first let's talk about Medicare and Social Security. Medicare and Social Security are both funded by the same kind of tax. It's called the federal payroll tax. Social Security is a specific tax referred to as FICA, F-I-C-A, FICA. That's an acronym for a federal law called the Federal Insurance Contributions Act. That's a federal law that gives the government the right to extract money from our paychecks before we get it, to put into federal programs for health insurance, like and retirement. They also refer to it as OASDI. That stands for Old Age Survivor and Disability Insurance. OASDHI is, they inserted the word health. Don't get all hung up on it. They just may use these different acronyms to try to confuse you, but they all refer back to this program called Social Security, a federal payroll tax to fund Social Security. The percentages are not important. I just put them up there to get people to aware. Most people are not aware. When you go to work for somebody, they're taking 6.2% of your pay out before you get it, up to a maximum of $700 to $800 a year. That pays for Social Security. Your boss matches it, by the way, with another 6.2%. So if you make up to $127,200 a year this year, then that means between your boss and you, 12.4% of that went to fund your Social Security benefit, which is like $15,000. You don't need to know that number. I just thought it would be interesting to know. Where does the money come from? Well, that's where it comes from. Medicare is also, as I said, Medicare is also a federal payroll tax. You might need to know this number, 2.9%. The federal payroll tax to take care of Medicare is 2.9%. You pay half, the boss pays half. And in both of these cases, if you're self-employed, you pay it all. Medicaid, on the other hand, there's 2 sources of funds, and none of them are a payroll tax. So don't let them confuse you on the test. That's where the confusion comes in. The difference between a payroll tax or not a payroll tax. So Social Security and Medicare are federal payroll taxes. Medicaid comes from the general revenues of a state. There are no federal payroll taxes. You can look, or state, you look on your pay stubs if you ever have one from an old job. Nowhere on that pay stub does it talk about a Medicaid tax. You'll see Medicare, you'll see FICA, but you won't see Medicaid. So there are state funds and federal assistance. So two sources of funds. That's where the money comes from. Medicare, Social Security, and then Medicaid. So now, who is it for? Well, Social Security is primarily for people 65 and older. Now, there are three benefits out of Social Security. Three benefits from Social Security. Three primary benefits. And most of the time, most all benefits are for those 65 and older. Medicare is the health insurance part. Okay? Medicare is health insurance for those 65 and older. Then we have Medicaid, and Medicaid is health insurance for the poor. So we have Social Security, which has three benefits. We're going to talk about them on another slide. Then we have Medicare, which is health insurance for those 65 and older. Then we have Medicaid, which is health insurance for the poor. Not bad folks, just folks having bad times. I'm glad we live in a country that can afford to set aside some money to help those who can't help themselves. I become a little annoyed when I find people who can take care of themselves want me to pay for their stuff. I ain't doing that. Then I get annoyed. I don't know about y'all, but in this country we take our families first. Take ourselves and family. I don't want anybody taking care of my family but me. Now, if I can't because of some unique circumstances, I would hope I could get some help. But that's my first job, is to take care of my family. But anyway, I'm off my soapbox. So one of the ways to separate Medicare and Medicaid, Medicare, we care for the elderly. Medicaid, aid the poor. Think of it that way. Care for the elderly, aid the poor. Those are the differences between the two. Now, let's talk about the three benefits under Social Security. Retirement is one that comes to most people's minds. Retirement. Then we also have what's called the disability income benefit. But you got to be disabled before you're 65 to get that benefit. And then we have what's called a survivor benefit. And one of the survivor benefits, you may see this on the test, is a $255 lump sum death benefit to the surviving spouse. That's almost laughable. Now, in 1935, when they first set up Social Security, that might have been enough to help pay to bury a loved one. In today's economy, that's barely enough money to put a letter in a tombstone. $255. And it usually only goes to the surviving spouse. There's also a topic we're going to discuss called the blackout period, which means the surviving spouse will not get any money other than that $255 until they turn 60. We'll talk about that in a minute. We'll do that using an example. This is not a specific test question. This is generic. So let's assume we have a worker who's 42. They're covered by Social Security. In other words, they're paying into the system, and they die. They leave behind a spouse, 38, a child is 12. So let's talk about what would happen. What are the survivor benefits here? Well, one, we already know $255 is going to the surviving spouse. And they put a little note on that thing. It says, don't spend it all in one place. No, I'm only kidding. They don't do that. But anyway, $255 to the surviving spouse. Now, because we've got a child under the age of 18, Social Security will help provide dollars to raise that child till they're about 18. The exact age varies. You're not going to get that on your test. But suffice to say, be aware, a check will be paid for the benefit of the child. Where does the check come? What is it? What generates the amount? How much did that worker who died, what did they earn? It was based upon their earnings. There's a minimum and a maximum amount, but it's based upon the earnings of that deceased worker. A check is also going to be paid to the caregiver of the child. You notice I didn't say the surviving spouse of the child. And that's a distinction you need to try to remember. The caregiver of the child is not necessarily the surviving spouse. perhaps the child's going to go to grandma, and grandma is going to raise that child. So grandma is the caregiver. So the money is going to go to grandma that would have gone to the surviving spouse. So whoever is the caregiver is going to get money. Kind of like having a child in foster care where they pay families money to raise a foster child. Same idea. It's not exactly a perfect analogy, but that's the point. So understand that surviving spouse receives absolutely no benefits other than that $255 until they turn 60. See, at age 60, that surviving spouse could apply for benefits from Social Security based upon their deceased spouse work record. So that surviving spouse might say, hey, Social Security, what am I going to do? I'm 38 years old and I lost my spouse and everybody else is getting money. How come I'm not getting any money? And Social Security responds with a 4-letter word, work. Go to work. When you turn 60, you can apply for benefits based upon your deceased spouse work record, but not before that. But by the way, this is not for your test. By the way, don't make too much money, because if you're making too much money, we won't let you have that money. Yeah, it's really weird, but it's a long, okay. But you need to be aware of these benefits, okay? So these are called survivor benefits, huh? Survivor benefits as a result of a worker covered under Social Security dying. The death benefit to the surviving spouse, check for the benefit of the kid, check to the caregiver, not the surviving spouse, and then age 60. That's the blackout period. From the time that spouse was 38, which is when they lost their spouse, to the time they turned 60 is referred to as the blackout period. That's called the blackout period. So why does government insurance exist? There's your answer. I hope that makes sense. It should. To fulfill a social goal. That's why they call it Social Security. Fulfill a social goal. But let's ask you another question. Why does private insurance exist? Answer, profit. Nothing wrong with profit. Thank God for profit. That's why you're here. That's why you're in this class. Is the chance for you to have some income, make a profit from your efforts. Okay, nothing wrong with profit. It's how profit is used that may make it bad, okay? So profit's not a bad thing. Profit's not a bad thing. There would be no insurance. There would be no New York Life. There'd be no Anthem. There'd be no Aetna. There'd be no Humana. There'd be no, your company wouldn't exist either if there wasn't a chance for profit. Now let's talk about another way we identify insurance companies as either being admitted or not admitted. Admitted or not admitted. Admitted companies are also referred to as authorized. They have a license to do business in a state. They have to jump over hurdles and through hoops to qualify financially, prove to the state that they're going to do business in, prove to that state that they have the financial resources required to pay the claims that come in. That's called being fiscally sound, okay? It's called the legal reserve. They have enough money in reserve to meet the legal requirements to be approved to do business in a state. Admitted. You and I can only do business with admitted companies. Then we have non-admitted companies. This should not be rocket science, huh? Not authorized, no certificate of authority. We can't do business with non-admitted companies, okay? Let's move to completing the application. Completing the application. One of the major processes, the first step in helping somebody get an insurance policy is to complete an application. The application is 3 parts. Part 1 consists of things like a person's name and address, their social security number, the name of a beneficiary if there's a death benefit, what are they buying, how much premium they're going to be paying, and you and I can help calculate that. And then other identifying information like where were they born, their driver's license number, just to make sure this is a real person. Part 2 is the medical information. Those are usually a series of yes or no answers. If there's a yes answer, we're going to be required to explain why those answers are yes. It's not a complicated thing, but insurance companies want to know why. And they also will be gathering the name and address of any physicians that this person may be seeing or has seen. Now, that's part 1 and 2. Signatures are applied to the application after part 2. When that policy is issued, parts 1 and 2 are stapled to the back of the contract. If you have an insurance policy at home, I'd recommend you pull it out and take a look and staple somewhere near the back or probably at the back parts 1 and 2 of the application because they become part of the contract. Part 3 is the agent report. This is the place where you and I get to help the home office underwriter do their job. Now, we haven't talked about the home office underwriter, but that's the person who's responsible to make sure that only insurable risks get insurance. They have to do the legwork, so to speak. And our agent report is the place that we might tell the underwriter something that we observed that wasn't covered on the application. Example, I had an appointment with a client in, been so long ago, I almost forgot where it was, okay? It was in Southern California. Oh, my God. Anyway, it's a beach community in Southern California. Redondo Beach, I think it was. Anyway, it doesn't matter. Anyway, we were sitting there, and he wanted to buy some insurance, and we asked him, did he scuba dive, which is a common question. And he said no, but in the living room was scuba gear. So I had to ask him about the scuba gear because the insurance company wanted to know as part of the application. And he said, oh, that wasn't his scuba gear. That was his buddy's scuba gear. He didn't scuba dive. So fine, I can't call him a liar. I just answer the question the way he answered it. But, he doesn't scuba dive. But on part 3, I put a note to the underwriter. I have reason to believe the customer is a scuba diver. I saw scuba gear in his living room. I didn't accuse him of being a scuba diver. I just reported what I saw. And now the underwriter has information they wouldn't have had if I hadn't jotted it down. That's what part 3 is about. We do that away from the client, either back at our office or at home. And part 3 is not part of the agent report. It's not part of the application, part of the contract. Part of the application, not part of the contract. Let me refresh you, make sure we got this right. Application is 3 parts. Parts 1 and 2 become part of the contract. Part 3 does not become part of the contract. The client has a right to see part 3, by the way. So, you got to be professional. Writing down the jerk lied to me. He's a scuba diver, was probably not a cool idea. Okay, be professional and make sure you do it right. Application. We have certain responsibilities, and so does the customer. Our responsibility is very simple. Ask all the questions, probe if we think they're not telling us the truth, or if they don't understand. Because as you probably picked up from the agent report, we are the eyes and ears of the home office underwriter. We're the only person that represents the insurance company that will ever come face-to-face with the client. So we have a very unique and important responsibility in this process of underwriting the risk. We are the eyes and ears of the home office underwriter. The customer has one responsibility, just tell us the truth. Thank you very much. Then the signatures get applied. We just talked about signatures, huh? One of the questions you may get is, how many? First of all, we already found out it's where? After, at the end of part 2. That's where it is, where the signatures are. But how many? Well, that depends. Depends on ownership. Normally, we need 2 signatures because normally the owner and the insured are the same person. And then you and I, as an agent of the insurance company, put our signature as well. If the owner's not the insured, then we need 3 signatures. Why do we need that separate signature of the insured? Costs. Here's why. Even though we might have insurable interest in that person, we don't have the right to have a policy of insurance on them without their written permission. So we can't sneak around behind their backs and buy a lot of insurance without their knowing. Can't be done. Got to have their written permission, and that signature gives that. So how many signatures is determined by ownership? Trying to keep that in mind. Forget life insurance disclosures. Skip this slide. It's got nothing to do with us. I got to get rid of this, but I haven't had a chance. Let's go. It should be at the top of page 5 of your slides. Change the application. This world is moving towards electronic applications, so human error is being phased out a little bit. But there's still some paper apps, and you may get a question on a test. Because when we fill out a paper app, it's easy to make an error. Mistakes happen. You're human beings. So if we're going to change the application, the question on the test is going to be, well, who makes the change? Answer is the customer makes the change. Think about it. Whose answer is being changed? Customer. So who has to initial it? The customer. Got it? You and I don't have to. Now, in the real world, if I'm doing an app, a paper app, there's a mistake, I'll make the change. There's nothing illegal about I make a mistake on his birthday, so I make the change. But here's what I'm going to do to comply with the law. I draw a thin line through the wrong part of the answer. I put the right answer somewhere around it, above it. Then I hand the pen to the client so they can initial the change, which impacts, has the effect of them making the change. Also, we may never, ever use whiteout, no erasing. Okay? No whiteout, no erasing. Underwriters are like police officers. They want to know what's underneath there. It's not a bad thing. Okay? It's a good thing. Now, there are consequences to incomplete applications. Applications must be completely and accurately filled out with proper signatures. Consequences of incomplete applications can be a problem. If there are any unanswered questions, the company waives the right to have an answer. So what am I talking about here? What am I talking about? Here's what we're going to do. This is going to be a little bit of a lengthy explanation. So what I'm going to do is we're going to so if an application is incomplete, the concept of post-claims underwriting comes into play. Insurance companies may never, oops, something's happening here. I got a call. Hold on. Yeah, Chris, what's up? Hello? Yeah, I am. I'm online. I'm talking. Oh, well, let me double check, okay? All right. Because I was able to hear them. I could hear. Let me take a look here. I don't see any mics on, though. Let's see. Which one? Maybe you went offline. Can you see my slide? We've got to kind of start over and review this topic again, because this is important and it can be on your test. So the concept of incomplete applications. And the quick example, I'll recap it real quickly. Filling out an application, there's a question about diabetes. We missed it. It never got answered. Policy gets issued. The guy really did have diabetes. He goes into diabetic coma. He's now in the hospital. The company's got to pay the claim. There's a principle at stake called post-claims underwriting. Insurance company may not try to underwrite the contract after the claim comes in. They had their opportunity to underwrite it before the policy was issued. So post-claims underwriting is not allowed. Therefore, when a policy gets issued with an unanswered question, the company's stuck. Okay? They can't go back and say, oh, if we knew that there was a problem, we wouldn't have issued it. Well, too late. You can't do that. And it revolves around another principle as well, principle of waiver. Once we waive a right, once you waive a right, then one is, and this is a key word as well, ESTOPPED, stopped from reasserting that right. So once someone waives a right, someone or some company waives a right, then they are stopped from reasserting that right. That's a legal term, stopped, meaning they can't, okay? They can't do it. They're just SOL. And that's the principle that's involved here. So when a company issued this policy with an unanswered question, they waived their right to an answer. Plain and simple. They got to pay the claim. Now, this doesn't happen in the real world. I've never seen it happen, but that doesn't mean you won't get asked about it on the test. Normally, somebody will catch the mistake. If the underwriter catches the error before the policy gets fully underwritten, they will send the application back to the agent, and then the agent has to jump in their vehicle and go visit the client and get that part answered, and the client has to initial it. So that's the process. So you don't want to miss any questions. It's better to do it right the first time, which is one of the reasons why a lot of companies are moving towards electronic apps, because the chance for missing questions is greatly eliminated. So no post-claims underwriting, not allowed. Now let's get some more definitions out of the way. The idea of warranty, warranties, representations, misrepresentations, these might show up on your test. A warranty is a statement that's true in every aspect. There's no wiggle room with a warranty. It's either true or it isn't true. It's either black or white. It's either one side of the coin or the other. And insurance companies make warranties, not clients, insureds, customers, any word they want to use. Never make a warranty. Companies make warranties. And if the warranty is violated or breached, then a contract is rescinded, void from the beginning as if it never existed. And the customer gets all their money back, period. Representation, on the other hand, are statements that are made based upon someone's best knowledge and belief. So there's a difference between a warranty and a representation. A representation is not a guarantee. It's not a warranty. Representations are different. So answers on applications are always going to be considered to be representations. And that's what the applicant or the customer is doing. They're making a representation. If the facts don't correspond to the answer, that in fact becomes a misrepresentation. I don't think you need to be schooled on that fact. However, how does that work in insurance? What happens if we have a misrepresentation? Well, it depends. It depends upon whether that misrepresentation was material or not. So let's define materiality. Had the insurance company known the truth, they wouldn't have issued the policy. Or they would have issued it under different terms and conditions, maybe with a higher premium. So the insurance company would have taken a different tack when they issued it with a material misrepresentation. So materiality is the issue, not misrepresentation. Material misrepresentations are the problem. Misrepresentations that are not material aren't important. That's the idea of the word. Fraud. I'm not an attorney, but this is what I'm told. The intentional misrepresentation or concealment with the intent to cheat. That would be fraud. Now, fraud or material misrepresentations can be cause to rescind a life insurance or, for your purposes, guaranteed renewable health contract if it's discovered within the first 2 years. We've introduced 2 new things to you now. Words guaranteed renewable health insurance and the idea of within the first 2 years. Every insurance policy, not every, but every life and health insurance policy issued in Virginia. Whoops. Oh, I got the wrong thing here. Okay. Every health or life insurance policy issued in Virginia has what's called a contestability period. And it's 2 years. Once the contract has been enforced for 2 years, it becomes incontestable. Even for fraud. Incontestable from this point of view. During the first 2 years the contract's enforced, the insurance company has the right to contest any answer on that application for materiality, material misrepresentation or concealment, or fraud. And if they find it to be true, they can rescind the contract and the policy is over. They give the client his money back and they take a walk. But after 2 years, the contract becomes incontestable. Because think about this. Could you imagine having a policy that you've been paying for 20 years, and then you file a claim, and the insurance company then goes back and looks at an answer, and they make a determination that you made a material misrepresentation, and they say, we're not going to pay that claim, and we're going to give you back the, well, that's not acting in good faith, okay? So they can't do that. This concept of contestable and contestable may show up on your test. So that's the issue here about contestability, 2 years. Waiver and estoppel, we've already covered. Waiver, if you have a right, you have a right to waive the right. Estoppel prevents someone from reasserting the right. Now, when somebody gives us money, we got to give them a receipt. On page, should be on page 6 on your slides, in the middle on the right-hand side. That's my guess. Conditional receipt. So when we give somebody a receipt for the money they've paid us, that receipt says you are covered from today on the condition we determine you're insurable. So it doesn't say you're covered from today unconditionally. It doesn't say you're covered from today no matter what. It says you're covered from today on the condition we determine you're insurable. So the insurance company reserves the right to take some steps to verify that person's insurability. So a conditional receipt basically says coverage is going to begin the later of, yeah, it could be the date of the app, or maybe the date of a medical exam. If a medical exam is required, then there is no coverage until the medical exam is done. Now, in health insurance, they generally do not do medical exams, just as a point of information for you guys. They generally don't do medical exams for health insurance, but sometimes they throw this out on the test, and I want you to be at least aware of it. If there happens to be a medical exam required, there is never any coverage until the medical exam has been completed. Or maybe the coverage is not going to begin until some date in the future requested by the customer. Perhaps the customer's got a group plan at work that's going to expire in 30 days, and they're buying a policy today, but they don't want that coverage to start until their other policy ends. That would be a possibility. Or maybe the insurance company might say, in no event will you be covered until 10 days after the policy is issued. They got all kinds of ways to do that. But you need to understand a conditional receipt does not mean you're covered automatically today just because you gave us money. My recommendation to you would be to review the conditional receipts of the various policies your company offers and become familiar with them, so that when you ultimately give somebody a receipt, should they give you money, you'll know how to explain it to them without making them read the entire thing. I mean, it might be only a paragraph and it could be 2 pages long. So it would be in your best interest and the client's best interest for you to have an understanding of what are the conditions of that conditional receipt. Now, we're going to skip from page 6 to page 8. All the stuff that I'm just telling you from skip to page 6 to 8, that's all life insurance stuff. So we're going to skip. Just stay with me here. And we're going to start with the slide on underwriting, which is at the bottom of page 8 of your slides. It should be page 8, I hope. There it is, underwriting. I hope everybody caught up. Bottom of page 8 on the left, underwriting. Concept. And this is what happens in real life. Policies are underwritten where the underwriter is a person or employed by the insurance company who has the responsibility to protect the company from making bad choices. They are the last line of defense, if you will, from an uninsured person getting an insurance policy. So the process of underwriting is the process, and the first bullet, what does it say? Selecting, classifying, and rating risks. That's the process. The home office underwriter is an employee of the insurance company who has a responsibility. You may see this on your test. That's why it's in red, to protect the insurance company from making bad choices. So they select, classify, and rate risks. They look at the application to determine that a person is insurable. Once they're selected as insurable, then they will classify that person based upon age, gender, health characteristics. So they put them in a class, and then they charge people of a similar class the same premium. That's where the rate comes from. The rate comes from the actuary who crunched the numbers using those morbidity tables we talked about earlier. But the underwriter applies the rate. You and I are referred to as the field underwriter, And our job is to do everything we can to assist the home office underwriter in doing their job, making sure that we have the application completely filled out. All the signatures are there. Any yes answers have explanations. If we have information we want to transmit to the underwriter that's necessary, we use what? We use the agent report to take care of that. That's our job. And then we already talked about the actuary. So when a policy of health insurance is finally presented to an underwriter for review, that home office underwriter has 4 options. 1, they could issue the policy with a standard rating. That's the benchmark. That's standard. Or if the person has some medical issues but still not uninsurable, they're not totally uninsurable, they just have some medical issues the insurance company might be concerned about, they could issue the policy with what's called a substandard rating. And if the person is healthier than the average bear, the company will issue the policy with a preferred rating. I think you can figure this out. The preferred rating has got a lower premium than the standard and even much lower than the substandard. So that's the way it works. Of course, the insurance company could also decline the application. Now, in today's world, under the Affordable Care Act, that doesn't happen that often. But in many of the products you'll be offering, they're not subject to the Affordable Care Act. Disability income policies, some cancer policies, stuff like that. Those are underwritten, and they could get declined. There's nothing saying they have. No one has a right to have an insurance policy, regardless of what government says. That's one of the reasons why premiums are going through the roof. Government's trying to make it a right. Insurance companies have to cover the risk, but they got to charge the premium. Otherwise, they'll go broke. You know, people complain to me a lot about premiums going up. I say, well, you know, don't shoot the messenger. You don't want your insurance company to go broke just before they're ready to pay you your claim. So when they put mandates on insurance companies, they've got to cover those mandates, the cost of those mandates, the only way they can, charging a higher premium. One of the other steps in the underwriting process is the underwriter will check data on what's called the Medical Information Bureau, the MIB. The MIB is not a movie. It's a database of information solely for the use of the insurance company and solely available to those who only have a need to see it. You will not have access to the MIB. It's a database of information maintained by insurance companies, and the purpose, here we go, to detect fraud, to help the insurance company prevent somebody from trying to get over on them. Now, one of the questions you may get about the MIB is, what can the insurance company do if they find something on the MIB that's negative that they haven't been able to find out on their own? And if it's negative enough, they may want to decline the client or charge him more premium. Well, the insurance company cannot use that information at face value to make that decision. They have to investigate to find out if that information is still accurate, because there's always a possibility that information could be old, inaccurate, whatever. So the insurance company cannot use information they find on the MIB as the sole reason to decide whether or not to issue or charge more premium. Fair Credit Reporting Act. Insurance companies utilize credit bureaus to find out about their potential insureds. We talked about why earlier, moral and morale risk. One of the questions you may get is, how does the insurance company utilize the credit bureaus? Well, they ask for one of two kinds of reports. Normally, all they're going to ask for is what's called a consumer report. They come from credit reporting agencies. They're nothing more than a printout that gives the insurance company information about that person's character, credit, reputation, and habits. If the customer is asking for the insurance company to take a significant risk, the insurance company may want to know more, so they may do what's called an investigative consumer report. I don't think I need to explain to you the difference, okay? But they're the same thing. The difference is the format, where they have sent someone out, ask questions of associates and employers and fellow employees. When somebody's asking for a lot of insurance companies want to know who they're doing business with. Goes back to that again. Forget STOLI, forget AKA IOLI, that's life insurance, ignore it, okay? Ignore it. Top right, page 9 is where you ought to be. Delivery. Now, in most cases, at least with your company, I believe, they mail the policies directly to your client. Sometimes you might have it mailed to you. The question on a test makes assumption that the policy is being mailed to the agent for delivery to the client. So there's a question about delivery of the policy. So we must complete what is called constructive delivery, which means nothing more than we've got to get a signature that proves we've delivered it. And that signature must be on a form. I'm going to write this name down in case you might not be able to remember this. The name of the form that we have to get signed when we deliver the policy I know I'm being funny here. Policy delivery receipt. That's we got to get that signed, and it must be dated, signed and dated. Insurance company wants to know when it was delivered and the fact that it was delivered. Then we have to submit that back to the insurance company if we personally deliver the contract. Constructive delivery. Policy delivery receipt has to be signed. Ideally, I personally feel the best way to do it is in person. Gives me a number of options, gives me some chance to make sure that they understand what they bought, so buyer's remorse doesn't kick in. Also gives me a chance to perhaps ask for referrals, which is not a bad thing. It's just, in my opinion, better. But some companies just prefer to mail them and, just work with it. It's fine. And sometimes if you've got an account you signed up with 15 or 20 employees, it may not be possible for you to deliver all those policies. It may be easier, more efficient to have them mailed. That's not a decision I make. It's a decision the insurance company makes. Now, if you and I cannot deliver the policy in person, if that's what we're going to do, we have it to deliver. If we can't deliver it in person, then we can deliver it by mail, but it must be certified or registered mail. Remember, we need a signature and a date, and that's how we get it. Regular U.S. postage isn't the point here. Additionally, in health insurance, insurance companies might also require, if we're going to deliver the policy personally, to get an additional document signed, referred to as a statement of continued good health. A statement of continued good health, which, just as it implies, says the customer is signing this, stating and attesting to the fact that their health has not had a significant change since the date they applied for it. Just a further step in the underwriting process to avoid adverse selection. It doesn't happen that often, but it may show up on your test. I don't want you to become blindsided by those phrases. So when, after all is said and done, does coverage begin? The first bullet is your answer. When all the premium has been collected and the policy has been issued, that's when coverage begins. See, a customer may apply for a policy and not pay any premium. The policy gets issued. Well, the policy is not in effect until you collect the premium. Customer may apply for a policy and pay the premium with the policy. Well, when the insurance company issues the policy, they issue them substandard rate, meaning they got to pay more. So all the premium's not been paid. So the policy doesn't cover this individual until you deliver it and collect the additional premium. See, when all the premium is collected and the policy is issued, I have the word issued in red, that's when coverage begins. Not when the policy is delivered. Premium collected and policy delivered? No. Premium collected and the policy issued, that's when coverage begins. When all of that is in place, coverage begins. And remember, with non-medical, it could be as early as the date of the application. And as we said, with medical, never until the exam is done. Insurance policies are contracts. And the world of contract law comes into play here. So there's a couple of pieces of this puzzle you need to get handled. Number one, all contracts, even insurance contracts, have certain essential elements that must be there for the contract to be enforceable. Number one, there must be an agreement. An agreement consists of someone making an offer and someone accepting that offer. Offer and acceptance equals agreement. Additionally, there must be something of value that's exchanged between and among the parties. That's called consideration. Something of value that's exchanged is called consideration. The parties have to be competent, and it must be for a legal purpose. So there's 4 essential elements for all contracts, which would include insurance contracts. However, insurance contracts are unique. So let's see how these elements work in an insurance contract. In an insurance contract, 99.9% of the time, the offer comes from the customer in the form of a completed signed application along with the first, what is called modal premium, the first modal premium, M-O-D-E-L, modal. That's not model. That's, I spelled it wrong. Modal, M-O-D-A-L, modal premium. That's the first, modal means frequency. Weekly, monthly, quarterly, semi-annually, annually, that's frequency of payment. They call it mode of payment, modal. So when a customer fills out an application and submits the first full modal premium, that's considered to be the offer from the customer. Application and premium. Ideally, the insurance company is going to look over that application. The underwriter is going to look it over and do whatever checking they need to do. And they've determined the person is insurable under the terms of the contract. The policy will be issued. The company has accepted the risk and issued the policy. But it doesn't always work out that way. That's why the word or is there. Sometimes after the customer makes their offer, the insurance company says, we find that you're insurable. However, we got a little problem with some of your medical history, and we need to charge you more money. We're going to issue substandard. We're going to charge you more money. So any step from this point is referred to as a counteroffer, voids the original offer. They're willing to issue the policy, but at a higher premium, which means the acceptance doesn't occur in this situation until the customer pays the additional premium. Just a different step. And you get a question that has verbiage, gives you some scenario. That's why you have to read it to see what they're asking about. In either case, we ended up with all the premiums been paid, the application's been submitted, and the policy's been issued. It's just a different set of steps. Consideration from the customer is the application and premium. So you may get one of 2 different questions. What is the offer from the customer? Answer, application and premium. What is the valuable consideration from the customer? Application and premium. Now, they're not going to be that simple questions, but I'm trying to get you the idea. Point that you have 2 different questions and the same answer for either one, because it's true. They can serve double purposes. The application and premium serves as the customer's offer, and it also serves to be the customer's valuable consideration. The application is value. The insurance company is going to look at the information to determine whether they're going to issue the policy. Of course, premium is money. Last time I checked, that has value. The company makes a promise. That has value. I could promise to pay your hospital bill if you go into the hospital. That doesn't have the same value as if an insurance company makes you that promise. So get that clear. Parties have to be competent. No drugs or alcohol, legal or otherwise. That could if it were the case, invalidate the contract. They have to be mentally sound, and they have to be a specific age. Now, be careful. Watch for this. In Virginia, the legal age that one must be to be considered an adult and have their own insurance policy is 15, not 18 or 21, as some people might think, but 15. So in the Commonwealth, anyone who's 15 or older is considered to be an adult when it comes to owning their own insurance policy. Anyone under the age of 15 is going to be considered a minor. So the legal age at which someone is considered to be competent to own an insurance policy in Virginia is 15. I don't know why. It's just the way it is. And of course, it must be enforceable in court. Enter into a contract to hold up the bank is probably not going to be a legal contract. So this is something let's just talk about. It's a typical question. Mary applies for $50,000 whole life policy, and it could be any kind of insurance, okay? Non-medical. She pays the initial premium, killed in an auto accident 2 days later. Which of the following will the insurance company do? The whole idea here is, when does coverage begin? Well, all the premiums have been paid. There was no medical exam. The application was in. The policy was issued, so the company's got to pay. That's the bottom line here. That's the point I'm trying to make to you. Policy was applied for. She paid the premium. Non-medical, so they needed any more information. The fact that she was killed in an auto accident, if the company still issues the policy, they got to pay the claim, period. All right, some more words for your vocabulary. This is where the glossary may come in handy. If you can't remember it, the glossary will help you. Aleatory or aleatory, depending upon what side of the tracks you come from. The word aleatory it means equal values or equal amounts are not exchanged. Think about it. You buy a health insurance policy, and if you never get sick, you're never going to get any money. You pay and pay and pay and pay and pay your premium, but you never get a benefit. So equal values are not exchanged. It's not necessary for equal values to be exchanged. Not like you sell me your car, we negotiate a price, I come up with the money, we negotiate, and I get your car. There's a perception of equal value being exchanged. That's not the way it works in insurance, okay? Equal amounts are not exchanged. That's what the word aleatory means. Sometimes they twist the words around just because they can, which is a challenge for people who have English as a second language. Because unequal amounts are exchanged is the same thing as saying equal amounts are not exchanged. Just a matter of our dumb language. I'm glad I was born into this language. If I had to learn it coming here from somewhere else, I'd probably gone back home. Crazy. We have a crazy language. Anyway, another word for you, adhesion. Insurance contracts are contracts of adhesion. Now, most of the contracts we enter into over our life are negotiated. Difference between a negotiated contract and a contract of adhesion. A contract of adhesion basically says the customer is required to adhere to a contract in which they have no input. You don't get to discuss or change wording in that contract when you can't cross words off and replace them with other words and put semicolons in. You didn't do that. Not with an insurance contract. Make a note. It's called take it or leave it. Contracts of adhesion are referred to as take it or leave it contracts. Now, because of the unique nature of a contract of adhesion, in the sense that it's take it or leave it, if you get your policy and you happen to be the only person in the history of man that reads their insurance policy, and you find a statement or phrase that's ambiguous or unclear, the only way we're going to get that resolved is to go to court. So the question may be revolving around what happens if there's a statement that's ambiguous or unclear. What's the result? Answer, we go to court, and the court is going to rule in favor of the person who did not draw up the contract, meaning customer wins, company loses. Now, I've never seen it happen in real life. They're pretty clear on the meanings, but just so you're aware, Tess likes to go that direction. Now, I don't know about y'all when you grew up, but I know when I grew up, my father especially, insisted that I never, ever sign anything till I read every word. Read it, read it, read it. Can't trust anybody. Read it, read it, read it. There's a principle involved. It's from the Latin called caveat emptor. Let the buyer beware. Well, insurance contracts are different. They're not contracts of caveat emptor. They're contracts of utmost good faith. It's assumed that everyone entering into an insurance contract is acting in good faith. Look at that second bullet. The assumption is everyone is acting in good faith. So if someone is not acting in good faith and we go to court, the judge isn't going to pay much attention to the person who tried to get over. Not going to happen. So simply stated, insurance contracts are contracts of utmost good faith. Contracts of insurance are also executory. Executory, meaning they don't execute and a specific condition occurs, also referred to as conditional. Conditional and executory are interchangeable. So there's no benefit paid unless a specific event occurs. Your auto insurance doesn't pay unless you have an auto wreck. Your health insurance policy doesn't pay unless you go to a doctor or a hospital and incur a medical bill. Life insurance policy doesn't pay until the insured is executed. The insured has to die. So no benefits paid unless a specific event occurs. There we go. There we go. There we go. Executory and conditional, they mean the same thing. Conditioned upon an event. Insurance contracts are also unilateral. Unilateral, meaning only one of the parties to this contract has a legal obligation to live up to the contract. And that's the insurance company. Only the insurance company has a legal obligation to live up to the contract, not the client. As long as you pay your premium in good faith and you file a legitimate claim, the insurance company's got to pay off. If they don't pay off, you can sue them. Now, on the other hand, if you don't pay your premium, they can't sue you. They can't take you to court, ruin your credit, and you'll lose your policy because you didn't pay for it, but they cannot take legal action against you, okay? Insurance contracts are also personal contracts. You should be somewhere on page 12 of your slide. Some of you are thinking, why aren't we in the textbook? The textbook is for you to use when you're not near a computer. You can look things up and go back and forth. I spend little time in the textbook. But the textbook, you know, people don't feel like they've gone to a class unless they have a textbook. So you got a textbook. Feel free to look it over. There's a lot of information about life and annuities in there that may be helpful to you at some point in the future. Also stuff about health. But you stay with me on the slides, we're going to do just fine. Insurance contracts are personal contracts. What does that mean? Well, it doesn't mean they're insuring a person, but it does mean the insured, the person being insured, cannot be changed without the consent of the insurance company. That's all it means. I own a life insurance policy on my wife. She's the insured. I'm the owner. That's possible. Why? I have insurable interest in her. Why? Strong love and affection, blood or marriage. Remember all that? Well, if, God forbid, we get divorced and I get a new wife, I'm not going to be able to call the insurance company up and say, hey, I got a new wife. Can we switch my old wife out, put my new wife into that policy? They're going to look at me and say, what are you, nuts? That policy wasn't based upon your new wife. It's based upon your other wife. If you want a life insurance policy on your new wife, buy a new one. So we can't change the insured is, who the insured is without the consent of the insurer. There is one type of policy out there that might be on your test that deals with changing the insured. It's called a key person policy, which we'll be talking about later. So the word conditional, executory are the same thing. We've already discussed it, right? We've already talked about the principle of indemnity to restore financially to the position we're in prior to the loss. Now, we're going to be switching now. We're going to be skipping. Skip all the way to page 27 in your slides. Go to page 27 in your slides. I'm going to give you a couple of seconds to get there. Page 27 in your slides, which is where I need to get to. So just hang in there with me. This is the rough part that I haven't had a chance to clean up and organize because of the change we made. But deal with it. You'll be fine. I went too fast for my computer. Give it a minute. It'll catch up. Oh, great. None of this needs to be covered anymore. So we're going to write through it. All right, let's see. Let's get to the right place here. All right, top of page 27 on the left. Mode of premium. Remember we talked about frequency, mode? That's not like pi a la mode. That's frequency, okay? When we say use the word first, modal premium. Now, in health insurance, sometimes premium is paid as frequently as weekly. So it could be weekly, monthly, quarterly, semi-annually, and annually. Now, here's a concept I want you to get. All insurance premium is calculated making an assumption. And the assumption is that all premium is going to be paid on an annual basis. The assumption is that all premium is paid on an annual basis. I told you I'm a terrible typist. Now, if somebody wants the convenience of paying more frequently than annually, they're going to pay more by the end of the year. So what I'm trying to say to you is, if somebody wants to be billed monthly, the insurance company is not going to take the annual premium divided by 12. They're going to put a factor in there because of the extra cost of handling more premium and the fact that they don't have that money to work with all year. So more frequently costs more by the end of the year. I hope that makes sense to you. And in health insurance, the word weekly might have been at the top of that list. So monthly, quarterly, semi-annually, weekly, the premiums are going to be, it's going to cost more by the end of the year because of the lost interest and administrative costs of handling more premium. Now, forget their life insurance grace period. Health insurance grace period. Down at the bottom of page 27, last one on the left. Grace period in a health insurance policy. Well, grace period is not a period of time that you pray that they pay. It's got nothing to do with prayer. It is, however, a period of time that you have to make your payment before you lose your policy, before it lapses. And as long as you make your premium payment before the end of the grace period, there's no additional costs or penalties. Just make your payment by the end of the grace period and you move forward. So grace period on health insurance policy is determined by the mode of payment. If the premium is being paid for weekly, then the grace period is 7 days. If the premium is being paid for monthly, then it's 10. Why is my battery running low? I got it plugged in, or at least I thought I had it plugged in. No, we didn't have it plugged in. How about that? Hold on. There we go. Okay. So weekly, monthly, quarterly, semi-annual. So there's 3 different grace periods, aren't there? Determined by mode of payment. not the whim of the insurance company, okay? So during the grace period, if the premium, of course, the premium has not been paid, if a claim comes in, the policy will pay. But they're going to deduct any unpaid premium from that claim. That benefits the customer. And why? Because it keeps the policy in force for future claims. So keep this in mind. Pay but deduct, right? Claim comes in, pay but deduct. If as long as you're in the grace period, policy is in force, pay but deduct. So if the premium on a health policy is paid less frequently than monthly, what's the grace period? I'm not asking you to shout out an answer. Just come up with one in your head. Premium on a health policy, paid less frequently than monthly. So many people come up with 7 days. And if you did, don't be worrying about it. Most people do. If you got it right, good. Because what you missed if you didn't get it right is that phrase right there. Goes back to understanding the question. If you're paying less frequently than monthly, then you must be paying quarterly, semi-annually, or annually, which sets the grace period at 31 days. That's the kind of stuff they do on a test to try to screw up with, screw you around. That's why we're doing this, so that we don't let that happen to you, or at least try to mitigate that to a great extent. Keep those issues from happening. Watch for it. If you have any questions about it, call me offline. Forget reinstatement of life insurance. Pass. Health insurance reinstatement. Health insurance reinstatement. If a policy goes beyond the grace period and the premium is up and paid, it will lapse. The customer may ask to have it reinstated. However, insurance company is not going to welcome you back like you're the prodigal son. They want to make sure you're still insurable again. So here are the steps. Make a new application. Prove you're insurable. Once that application is in, the company has 45 days to decide yay or nay, or the policy automatically reinstates. They can't hang you out to dry forever. What would be the advantage of reinstating a policy? Well, historically, older policies are more liberal in some of their definitions than newer policies. But that's becoming less of a problem under the Affordable Care Act. But anyway, just know the 45 days. You may see it on the test. Misstatement of age or gender, top of page 28 on the left. These are some provisions in the contract that may ask you questions about. What happens if somebody misstates their age or their gender, and then the insurance company finds out about it? What will the company do? Well, they're going to adjust the benefit to pay what should have been paid had the correct age or gender been known. It's nothing complicated. It's a no harm, no foul situation. By the way, it's gender at birth. It's gender at birth. Now, I want to take a second here and dive into that a little bit further. I want to talk about premium and refunds of premium. In insurance, all premium is paid in advance. What do I mean by that? If I pay $100 for 30 days worth of insurance, the insurance company doesn't get to keep that whole $100 if the policy doesn't go out the full 30 days. We have earned and unearned premium. So they will earn that $100 effectively 1/30th at a time over those 30 days. So if the policy cancels, then the customer is entitled to a refund of unearned premium. The question is, how much do they get back? And that answer revolves around who cancels. If the insurer is able to and cancels, then the customer is going to get what's called a pro rata or prorated refund of unearned premium. So, for example, if the insurance company canceled that policy on the 15th day, I'd get back $50. That would be the unearned premium. Now, if the insurer Ed cancels, then the insurance company is going to get to keep some money. That's referred to as a short rate refund. They're going to be shorted a few dollars for the administrative costs involved in canceling. So understand the concept of earned and unearned premium. How that premium, if the policy doesn't run to the end of the term, the customer is entitled to some or all of the unearned premium back, depending upon who cancels, okay? Depending upon who cancels. So if a person lies about their age and they're really younger than they said they were, they're not going to get a higher benefit. They're going to get a prorated refund of unearned premium. If they're older than they say they are, then they would have paid a higher premium. Now they'll adjust the benefit downward. So one way or the other, the insurance company is going to balance the scales. The insurance company is not going to be forced to pay out more than they would have been entitled to had they known the truth, nor are they allowed to keep more in premium than they're supposed to. And it's gender at birth, by the way. Automatic premium loan, you forget that. That's in life insurance only. Exclusions, you can forget that. Suicide, forget that. That's all life insurance. Waiver of premium. Where are we here? Where are we here? Hold on a minute. It gets a little rough because, oh, I know where we are. Okay, suicide. Here's what I want you to do. Skip over to page 36 in your slides. Skip over to page 36 in your slides. And on page 36 in your slides, which I'm going to get to as quickly as I can, because all of this stuff is life insurance. It starts out Virginia Health Insurance. Where did I get that? I want to go by it. Virginia Health Insurance. Now, some people are saying, why didn't you have all this ready? Well, I'm not making excuses, but I juggle a lot of balls. I do taxes as well as insurance and these classes. And up until the 18th of April, I've been pretty busy with some tax clients. So I didn't get this done the way I want, but we're good. This is good. So here we are. Virginia Health Insurance. These are talking about policies and stuff, okay? Before we get too deeply involved in Virginia Health Insurance, I want to talk with you and have you understand the tax issues with respect to various types of health insurance, because you may get some questions about tax issues when it comes to health insurance. And I would rather discuss that with you when you're somewhat fresh, not late tomorrow, okay? So this is not in the slides right now. Just follow along, take some notes, and ask me questions. It's okay. When they ask any questions about taxes when it comes to insurance, the questions will be revolving around one, the premium. Is the premium tax deductible or not? And then number two, benefits. Are the benefits taxable or not? Now, if you have knowledge in the world of income tax, this will be pretty easy for you. If you don't, you need to focus here with me. You're not going to have to be an expert on taxes, but they do ask these questions, so I want you to be prepared. And the answers to the questions depend upon the type of health insurance. Health insurance falls into two categories. medical expense, disability income. Medical expense insurance incorporates HMO, PPO, which we're going to be talking about. That's health maintenance organizations, preferred provider organizations, the cancer policies that companies offer, hospital indemnity policies that companies offer, policies that are designed to put money, help pay medical bills, okay, help finance medical bills. Disability income insurance is to replace the income of a breadwinner. I don't think that needs an explanation, okay? So there's two categories, and each category has a different tax issue. So we're going to do medical expense first. This is the easier one. Medical expense premium is always tax deductible. Benefit is always tax-free or not taxed. That's pretty straightforward. However, when some of the questions that come out about tax deductible of premium is how much of that premium is tax deductible, and that depends upon certain factors. So copy this down. Employers, if I could spell it'd be good. I can, but I'm having a hard time today. And those who are self-employed get to deduct 100% of the premium they pay from any health insurance that they pay for. Medical expense, I should say. Employees, which is basically the rest of the world, can only deduct the amount of health insurance, health premiums, plus any out-of-pocket expenses. That would include deductibles and copays and stuff like that, that exceed 10% of their adjusted gross income. Now, you're not going to have to calculate anybody's adjusted gross income, but you need to be aware of how this works. So if somebody's adjusted gross income, as an example, is $100,000, well, I don't think you need a mathematician for me to tell you that means 10% of that is $10,000. So if they have medical expenses, out-of-pocket medical expenses and premiums that do not exceed $10,000, they don't get to deduct any of it. If they have medical expenses and premium that out-of-pocket and premium that goes to $10,001, they get to deduct $1, only the amount that exceeds 10% of their AGI. Senior citizens, those 65 and older, that percentage drops to 7.5%. Stupid, but just something you may see on the test. So how much can the employee deduct from their taxes for any health insurance premium they pay, which would include any out-of-pocket, unreimbursed out-of-pocket expenses? Only the amount that exceeds 10% of their AGI. And the same is true for senior citizens, but it's 7.5%. Any question about that? Okay. Employers and self-employed, same thing, except they get to deduct all of it. Out-of-pocket expenses plus premium, 100%. Okay, 100%. In New Jersey, we say 100. 100%. All right. Stupid. So with health insurance, medical expense insurance, it's pretty straightforward. Premium is always tax deductible, no matter who pays it. Benefits are always tax-free, no matter who gets it. the questions revolve around how much. Now, talking about disability income is a little different. Disability income insurance. Now, premium is tax deductible. If the, if the payer and receiver are different. Disability income insurance. The premium is tax deductible if the payer and the receiver are different. For example, an employer who buys group health insurance for his employees, he or she will get to deduct 100% of that premium because the employer's paying, but if the employee gets disabled, the employee is getting the benefit. So the payer and the receiver are different. So the employer gets a tax deduction, 100% of the premium they pay, but if the employee gets disabled, remember the employee is going to get the benefit. So now, when the payer and the receiver are different, there's another rule here. The benefits are taxable to the receiver because somebody else paid the premium. The benefit that the other person gets is taxable. So that's the way IRS works a lot of times, huh? Somebody gets a tax deduction, then somebody's not going to pay taxes. So if you belong to a group plan at work, has a disability income policy, the employer is going to get a deduction. 100% of the premium they pay, they're going to get a deduction for that. And if, God forbid, you get disabled and that policy starts paying you a benefit, you're going to pay income taxes on the benefit. It's the way it works. Now, when the payer and receiver are the same, then there is no tax deduction for anybody. When they're the same, there's no tax deduction for anybody, and the benefits are tax-free. So if you buy your own personal disability income policy that you're paying for, and you become disabled, you did not get a tax deduction for the premium you paid, but the benefit you get will be tax-free. And if it works out where you got a group plan at work and your boss pays half the premium and you pay half the premium and you become disabled, that rule will still apply. The benefit that comes from half your benefit because your employer paid half the benefit is going to get taxed. You paid the other half, that half is not taxed. It's prorated based upon who paid. I hope that makes some sense to you. That's why I try to use this rule to making sure you understand it's about who's paying and who's getting, huh? When the payer and the receiver are the same, there's one set of rules. The rule is no tax deduction, but the benefits are tax-free. When the payer and the receiver are different tax rule. The payer gets a tax deduction and the receiver has to pay tax on that benefit. Okay, so let's move into health insurance. This may come up a little bit later, but we'll move forward. We're going to go to lunch about 12:30, about 45 minutes. Is there anyone who cannot wait till 12:30 to go to lunch or take a break? If we can hang in there, it'll be to everybody's benefit. But if you have to break, let me know. Okay, well, we're going to work right in there to 11:20. I may not be able to make it till 12:30, but hopefully I can. All right, health insurance. Remember, two categories, disability income and medical expense. Now let's talk about health insurance replacement. We should be on page 36 of your slides. And as you'll note, it goes down one side and then up to the bottom, upper right of the next. It's like an X. The world of health insurance has totally been turned upside down twice since 1980. In 1980, Congress passed a law I can't think. It just slipped right out of my mind. The Health Insurance Something Act, okay, which created HMOs and PPOs, managed care plans. I'll think about it later. And then more recently, we have what's called the Affordable Care Act. Commonly called Obamacare, okay? They both have totally turned the world upside down. So let me give you a little background here. This can help to get this background in your head. Prior to, that's what it's called. Let me go back up. See, that's what happens. If you just don't think about it for a minute, you'll be fine. Health insurance. It just went out of my head again. Don't you love it when you remember something and you can't remember it? Health insurance, I can't remember it. Anyway, prior to the passing of that act in 1983, which you don't need to know the name of, every insurance policy, medical health insurance policy sold in Virginia was referred to as a reimbursement policy. Reimbursement policy. And here's how it worked. If you got sick or hurt, you can go to any doctor you wanted. There was no such thing as a network. There were no networks. You go to any doctor you wanted. Your insurance company helped with the financing of your medical costs. That's what they were there for. You and the doctor took care of your medical needs, your medical treatment, your health care, and the insurance company helped you finance it. Big difference. The insurance company helped with the financing, and the doctor was responsible to help you with your medical care, and you and the doctor worked on that together. In 1983, they passed this law that I can't remember the name of, and I apologize for that. But for now, I can't remember it, but I will later. One of these things about memory, when you try too hard to remember, there's like a wall goes up and you can't bring it forward. Hold on a minute, please. Hold on. Bear with me. I got something handled. All right. Health Maintenance Act. There it is. Health Maintenance Act. Found it. Got it. It's called the Health. Oop, I'm in the wrong place. Sorry about that. Click it up here, Lou. Click it up here. It's called the Health Act. I'm making a lot about something that's not even on your test, but I get hung up. So when you can't remember it, a wall goes up and you can't remember it. So stop trying to think about it so hard and go on to do something else. And somewhere it'll bubble up. Hopefully not while you're driving home, okay? That's what just happened to me twice. I totally dismissed it from my memory, forgot about trying to remember it, and I got into other things and bang, it popped up. So this Health Maintenance Act of 1983. That was the first thing that screwed up medical insurance in the country. And then Affordable Care Act was the second thing. So anyway, so prior to the Health Maintenance Act of 1983, you go to any doctor you wanted. We had reimbursement policies. 100% of all group insurance at work was designed to do this. They were called major medical plans. If you got sick or hurt, you go to any doctor you wanted. There's no network. And then you had the responsibility, however, to pay the doc. You had a responsibility. You had the relationship with the doctor to pay the doctor for the care they provided to you. Then you took the bill and you submitted it to your insurance company, and they would reimburse you under the terms of the contract. They wouldn't always reimburse you 100%, but they'd reimburse you. You always had some skin in the game. That prevented overusage of the insurance. One of the questions you may get on the test is about deductibles. While I'm thinking about it, deductibles. Why do deductibles exist? And here's the answer. To prevent overusage of your policy. Because if you've got a deductible, you're less inclined to spend that money if you can get away without having to spend it. So you don't always use you're not looking to the insurance company to pay everything. So one of the reasons why there are deductibles is to prevent overusage. Watch for that on the test. But back to where we were. So when you go to any doctor you wanted, you had the responsibility to pay the doc. You might say, hey, doc, I know I got to pay you, brother, but I don't have the money. And he might say, well, here, what? You have insurance. You say, yeah, I got insurance. He said, okay, here's what I'd ask you to do. Assign your benefits to me. It's called an assignment of benefits. You might see it on the test. It's called an assignment of benefits. Assign your benefits to me so that when you submit your claim to the insurance company, they will send the check to the doctor. But they don't send the check to the doctor without you agreeing to it. That's what the assignment of benefits is about. Okay? And then if there's still any money left over, you could work out a deal with the doc and pay them. Well, with the advent of the Affordable Care Act, but the Health Maintenance Act of 1983, all of that went out the window, and that's when they created these, what are called MANAGED, managed care plans. And we just start health maintenance organizations, preferred provider organizations. These are managed care plans where you're in a network, and the doctor is paid by the insurance company. You're out of the loop. So the insurance company and the doctor have a contract. Doctor gets, so who's the doctor going to listen to? Whoever's paying them. So if you're paying them, then they're going to be more attentive to you and your needs, in my opinion, and you'll probably get better care, especially if you're vocal and they charge. Ask questions. But with an HMO PPO, you have that other entity called the insurance company who may decide that that treatment is no longer good for you. It's more expensive than they want to spend. Okay. So there's a big problem. That's enough for the test, but I had a big problem when these managed care plans came into play, because now they took the equation where the patient and the doctor had this relationship about health care. See, ladies and gentlemen, there's a big difference between health care and health insurance. Just because you have health insurance doesn't mean you can afford your health care, because if your deductible is $10,000 a year, you got the insurance, but you can't afford to get the care. So the verbiage that gets flown around through DC is confusing to Americans. They conflate health care and health insurance into one word. It's two different issues. I'd rather have access to health care that I can afford, and if I can get health insurance that I can afford to help me cover that and finance it, that's one thing. But if I have health insurance that still doesn't allow me to afford health care, what good is the health insurance? I'm on a soapbox. I'll get off it. But anyway, so we had this issue about reimbursement policy. So I want you to understand, before 1983, you had these reimbursement policies. After 1983, we moved into these managed care plans. So we're now going to open the door and start talking about these reimbursement plans, okay? Reimbursement plans. Now we're going to go back to the slide. So whenever we were going to replace an insurance policy prior to the Affordable Care Act, which is the second step that destroyed health insurance in America. They're not interested in health insurance. They're interested in controlling 1/5 of the economy. That's what they're interested in. Anyway, prior to the Affordable Care Act, if a customer didn't like what they had, we could replace it as long as they could qualify medically. We could replace it with any company they wanted at any time. They had a lot of choices. The problem is, if they weren't insurable, they'd have to stay with where they were. So we had to be careful that if we replaced the policy, they didn't end up in worse shape financially than they were before. So we had to be careful about that. It became an agent's responsibility. And the issue revolved around what are called pre-existing conditions. Now, under the Affordable Care Act, pre-existing conditions are non-existent. There's no such thing as a pre-existing condition under the Affordable Care Act. If any of you have ever taken out a health insurance policy through the network or through the exchanges, you know that the only questions they ask you are your name, your social security number, your address with zip code, your gender, and do you smoke or not? That's it. They're not asking you any medical questions because they're not underwriting it medically. Okay? So there's no such thing as pre-existing conditions. And there's a big selling point under the Affordable Care Act where people were told you're going to be guaranteed to get the insurance. It doesn't matter what your health is. Well, yeah, you're getting the insurance, but can you afford to get the care? Huh. I don't know. I don't have the answer. I'm not saying I have the answer, but I know what they have come up with is not the answer. Okay. So let's talk about pre-existing conditions. Let's get back to the test. Sorry about that. Let's get back to the test. Pre-existing conditions. Let's define pre-existing conditions because pre-existing conditions could be a factor on your test. What is a pre-existing condition? Any condition someone has seen, should have seen, or was recommended to see or get treatment. That's a pre-existing condition. Any condition someone has seen, should have seen, or is recommended to see, or get treatment from, I almost forgot, a medical practitioner. In English, a doctor. So that's a pre-existing condition. Now, if the insurance company, if you apply for an insurance policy, the insurance company wanted to know about pre-existing conditions under those traditional plans, and they ask you questions about it on the test. If there were no questions, I wouldn't even be talking about this topic, okay? So that's why we're talking about it. So here's the way they would work it. A pre-existing condition, the insurance companies only had a certain period of time they could look back in your history to see if you had a pre-existing condition. They had what we call look-back periods. So with individual policies, the insurance company can only look back 2 years to see if you had a pre-existing condition. If it was a group policy, they could only look back 1 year. And if it was any, what we refer to as senior product, that would be a Medicare supplement. I'm going to abbreviate it as MedSup, or long-term care insurance policies. They can only look back 6 months. You may need to know those dates, those numbers. So prior to the Health Maintenance Act of 1983, insurance companies would utilize pre-existing conditions. And even since then they could. The Affordable Care Act is what blew them out. Any condition someone has seen, should have seen, was recommended to see or get treatment for from a medical practitioner within a certain period of time before applying for the policy. How long was that period of time? Individual policies, they could look back 2 years. Group plans, they could look back 1. Senior products, which are MedSup and long-term care, they're going to look back 6 months. So now, if they found a pre-existing condition, what could the insurance company do? Well, they had a couple of choices. 1, they could deny coverage. 2, they could issue the policy as applied. Basically, ignore the pre-existing condition. That's their choice if they want it. Or they could issue the policy with a temporary exclusion, EXCLU, a temporary exclusion, excuse me, for that condition. Or it could issue the policy with a permanent exclusion. Permanent exclusion. So it had 4 options: deny, issue is applied, temporary exclusion, permanent exclusion, okay? Let's go back. If they issued the policy with a temporary exclusion, how long could they exclude? It had to be temporary, so it goes back to the look-back periods. Individual policies, I think you can figure this out. They could exclude for up to 2 years. With group policies, they could exclude up to 1 year. And with med-sup and long-term care, they can only exclude up to 6 months. So the time frames are the same. I'm just trying to give you as much way to tie this together as possible. So what could they do? Deny, issue is applied, or issue the policy with a temporary exclusion. For individuals, they could temporarily exclude that for up to, I don't know what happened there, but I don't know what happened. Up to 1 year or 6 months, depending. A permanent exclusion is referred to on the test as an impairment rider, not impairment, impairment. Told you I'm a lousy typist. So we're going to slow down and make sure you got this. So when a policy was applied for, pre-existing conditions became a problem. We defined pre-existing conditions. You should already have that. What could they do if they found a pre-existing condition? Well, there you have it. Four options. Deny, issue is applied, issue the policy with a temporary exclusion, then how long was temporary? That depended again upon the type of policy, or they issue the policy with an impairment rider. Okay? And sometimes it would be to the benefit of the customer. Maybe I apply for a policy and the insurance company looks back and says, Lou, you got a bad back. That bad back scares the dickens out of us. We'll issue you a health insurance policy, but we're not going to take care of any problems with your back. I might be willing to take that deal. Because heck, there's a whole lot of other things that could go wrong with me. I could get cancer. I could have a heart attack. Who knows what could happen to me? So half a loaf being better than none might be something I'd be willing to accept. So I could get something I could still afford, knowing I got this problem with my back. I have to figure out another way to deal with that. But at least I have insurance for something. Anyway, that's the whole idea behind those pre-existing conditions. So one of the problems with replacing a policy was this whole idea of pre-existing conditions, where they might have been covered under the existing contracts, but might not be covered under the new policy. Also, any new medical conditions they acquired in the old policy would now be a what? Pre-existing condition under the new policy. And there's your time frames: 2 year, 1 year, and 6 months. So here we go. Types of health policies. These are called traditional. Sometimes we call them traditional. Sometimes we call them reimbursement. The test bounces back and forth between reimbursement and traditional. We have basic plans. And you'll see on your slide in the middle of page 36 on the right. We're going to build that slide on the screen in front of you, okay? Three types of basic plans: a major medical plan and comprehensive major medical. So let's build it. So how do we know? What are the questions you're going to get about basic plans? What do we know about basic plans? Well, basic plans have what are called low limits of coverage. You were lucky to get $10, $15, maybe $20,000 worth of insurance help if you ever needed to go to a hospital or needed surgery or had to go to a doctor as an outpatient. 3 separate policies. If you wanted coverage in all 3 areas, you bought all 3 of them. So I could have a $20,000 basic hospital policy, but it'd only pay if I went into the hospital. I could pick and choose what I was concerned about and buy policy that would take care of what I was worried about. These policies are also identified by the fact that there's no deductible to get a benefit from the policy, no co-insurance, and no co-payments. They're referred to as first dollar coverage, meaning from the first dollar of loss, if I have a $20,000 basic hospital policy and I go into the hospital, that bill is paid for in full for the first $20,000. First dollar coverage. Now, I can't assume that everybody knows what those words mean, so we're going to make sure everybody understands what those words mean. Deductible, co-insurance, and co-payments. A deductible is an amount that must be paid by the insured before the insurance company pays, period. The higher the deductible, this should make sense to you if you may already know it, the higher the deductible, the lower the premium. The higher the deductible, the lower the premium, much like your auto insurance. I just raised the deductible on my cars because I wanted to save some money on premium. Okay. Co-insurance. Once you meet your deductible, then you had to also share in a part of the bill. That's called co-insurance, where the insurance company would pay a percentage and you'd pay a percentage of the bill after the deductible. It was expressed in terms of percentages. Could be 90-10, could be 80-20, could be 70-30, whatever it was, it was. The insurance company pays the higher percentage, you pay the lower percentage. Co-insurance. Copay. Copay. That's different. Copay is expressed in terms of real dollars. Oops, real dollars. Like some of you probably already know this. You go to a doctor, you have to pay them $15 just to show up. $15, $20 copay. Kind of like your admission to get on the ride. So there's a difference in co-insurance and copay. So let's recap. A policy that has a deductible means you have to pay a certain amount of money before the insurance company's paying anything. Once in health insurance now, once you meet your deductible, you will then enter the co-insurance phase where you pay the smaller portion of the bill percentage-wise and the company pays the bigger portion of the bill. A copay is just a dollar amount you pay every time you go get care. As I said, it's your admission to get on the ride. Now, while I'm here on this page, let's introduce a couple of other words to you, a couple other definitions. One of the definitions is called stop loss. Stop loss is a dollar amount in the policy. In other words, it's identifiable in the policy when the bill reaches the stop loss amount, the insurance company pays 100% of the bill. Think of it that the customer stops losing. That's what they're trying to say by stop loss. Customer stops losing. So stop loss, like say it's $5,000. It's identifiable. It's in the policy. So when the bill hits $5,000, not when you spend $5,000 as an insured, but when the bill hits $5,000, if that's the number, then the insurance company's going to pay 100% of the bill. So let's recap. Got a policy with a $5,000 stop loss, a $500 deductible. You go to the hospital. This is major medical. Go to the hospital. You got to pay the first $500 out of your pocket. Assuming there's an 80-20 co-insurance, you're now going to pay 20% of the bill. Insurance company's paying 80% of the bill. And when the bill hits $5,000, you stop paying, and the insurance company pays 100% of the bill from that point forward. Stop loss. So back to our slide here. Basic policies have no deductible, no co-insurance, and no co-payments. They're referred to as first dollar coverage policies. So when I went to the hospital with my $20,000 basic hospital policy, as long as the bill didn't go over $20,000, I had pretty good coverage. But when the bill blew beyond $20,000, the hospital's going to look to me to pick up the bill. However, if I were smart, I would have purchased a major medical policy. And the major medical policy is identified by the fact that it has very high limits of coverage. I've seen major medical policies with $1 million to $5 million worth of lifetime benefits. I mean, you got to be pretty sick to blow through $5 million worth of medical bills. So $1 million to $5 million, that's high limits. And what they also did when they created major medical policies is they incorporated hospital, surgical, and medical all in one policy. You didn't have to buy 3 separate policies. But to help mitigate the cost, they provided the opportunity for people to pick a deductible. There was co-insurance amounts and some co-payments that helped mitigate the cost. So once I blew through my 20 grand, my basic policy blew up. I got no more benefit. If I had a major medical policy, I could look to them to help pay my bill. However, before I got there, I'd have to pay a deductible, That deductible has a very specific term. It's called a corridor deductible. It's the deductible that has to be paid after the basic benefits are exhausted, but before the supplemental major medical benefits begin. Why did I change the word to supplemental? This is semantics, This is just semantics. If you have what's called a comprehensive major medical, that means you have basic and major medical in one package. And the terminology they use is that the major medical policy supplements the basic. This is a game of semantics. The major medical policy supplements the basic. So here's a stupid question you may get. But stupid or not, you want to get the right answer, right? Which of the following policies has a corridor deductible? Here's your answer. Supplemental major medical. That's what has the corridor deductible. Supplemental major medical. Comprehensive major medical is not an insurance policy. It's a description that someone has supplemental major medical plus the 3 basic policies. That's what it is. It's only a description. We have basic plans and major medical plans. When you combine them, you end up with comprehensive major medical. I know this is dumb, but I hope you get it. So question, which of the following policies has a corridor deductible? Supplemental major medical. Then the Health Maintenance Act of 1973, or 1983 rather, created this health maintenance organization. What do you need to know about HMOs? They focus on preventive care. They provided annual physicals at no additional cost. You might make a note. HMOs provide annual physical at no additional cost. Annual physicals are a form of preventive care. They catch it early, it's easier and less expensive to treat. I didn't say it was free. I didn't say annual physicals were free. I said annual physicals became available at no additional cost. They included it all in the premium you paid. There ain't no such thing as a free lunch. Now, HMOs are required to operate in a specific geographic service area, usually by county or zip codes. And now, with an HMO, we are no longer called insureds. We no longer are an insured that has a policy that will reimburse us. We're subscribers to a prepaid health plan. This is terminology, ladies and gentlemen. We are subscribers to a prepaid health plan. So they used to call us insurers, they now call us subscribers. So one of the questions you may get is describing an HMO as a prepaid health plan, because you're going to pay your premium and receive your care from the same organization, because you're going to have to go to a doctor in the network that this HMO provides. So you're going to the physician who's part of the network, you're paying your premium to the same company, you get your premium, and you receive your care from the same organization. It's a form of managed care. The most common type of HMO is called an Independent Practice Association, IPA, Independent Practice Association. And here's how it works. The HMO will contract with independent physicians in the geographic area that they're operating in. And when you, as a subscriber to that HMO, you will get a list of doctors that you can pick from as your primary care physician. The letters PCP are not referring to a drug, right? They refer to primary care physician. And now, question, how does that doctor get paid? Answer, capitation fee. Think of it by the head. See, the doctor does not make enough money to support their practice and raise a family on the $25 you give them every time you show up for treatment. They build their life on the capitation fee. So question, which type of health care delivery system pays a capitation fee? That's called an HMO. HMO pays a physician a capitation fee. They're going to get that check every month, whether you show up or not. Give me 2 minutes here. Hold on a second. Give me 2 minutes. Actually, 1 minute. Okay, so how does the HMO pay its doctors? Capitation fee. Okay, capitation fee. The other term you may see is that the primary care physician acts as a gatekeeper. So if your doctor, your primary care physician, who's usually a GP, general practitioner, if they think you need a specialist, they will refer you to a specialist. Think of it. They open the gate, refer to a specialist, but is also a member of that network. They're not going to refer you to somebody out of the network. Now, independent practice associations operate on what's either an open panel or a closed panel system. I don't even know why they asked this question, and hopefully you won't see it. But in case you do, I need you to be prepared. Here's the best way I can explain the difference. Let's assume you're a doctor. I make you all doctors. Poof, you're doctors. I'm an HMO, and I come to each of you, and I visit each of you in your offices. And I'm basically going to make the same presentation to each of you. It's going to go something like this. Hey, doc, we've got a ton of subscribers in this area. We need some more primary care physicians. Would you consider joining our network? We've checked you out. You're a fine doctor. You got great credentials. We would love for you to become part of our network. And you say, well, that's nice. I appreciate that. How much you going to pay me? In other words, what's my capitation fee? And I tell you, you say, okay. But now you're going to ask me another question. One of the questions you're going to ask me is, hey, Mr. HMO guy, you know, I got a practice here, a lot of patients that I see, and I don't want to give up those patients. Can I still see my current patients if I become part of your network? If I say, yeah, don't worry about it, that's an open panel IPA. If I say, oh, yeah, well, doc, yeah, that's another problem. You're going to have to give up your current practice, so you can only work exclusively with our subscribers. That's a closed panel. Now, I don't know why, but I think the big difference is going to be something about a capitation fee difference. But the test question may be about the difference between open panel and closed panel. If you understand what I explained to you, how it works, you shouldn't have any problem with the answer. Now, one of the downsides of being in any HMO plan is that you must get treatment from your network or it's not going to cover you unless it's an emergency. So if you happen to be out of state visiting and you belong to an HMO in Virginia and you got a tummy ache and don't feel good and think you should see a doc, it better be an emergency or your health insurance is not paying. Okay? So to help eliminate that, insurance companies expanded on the idea of HMOs and came up with what are called preferred provider organizations. They're very similar to HMOs in some respects, but different in other ways. One of the ways they're different is that with a PPO, the physician is not paid a capitation fee. The physician gets paid a fee when you show up. It's called fee for service. But the member also has more choices. So you're not limited to the network. Depending upon what doctor you go to, the insurance company might pay 90% of the bill or 80%. In other words, there's a co-insurance element to what doctor you go to. And that's determined by whether they're in network or out of network. We don't have to get into the minutiae on that. I want to get into the weeds on how it all works. Just be aware that with a PPO, the member has a lot more choices, how bad they want to see that doctor and whether that doctor is a part of the network or not, based upon their fees, may get 90, 80, or something less. You may have to pay more. And if you go totally out of the network, which you can do, you're going to have to reach in your pocket and perhaps pay half the bill. Those numbers are not chiseled in concrete. They're just designed to give you an idea. So I think you would agree with a PPO, you have a lot more choice. If you happen to be out of the area and you got a tummy ache, you can't find any doctor in your network, you can still go to a doctor and your PPO might pay half the bill. Okay. The blues. How did the blues get in this mix? I don't know. Well, here's how they got into the mix. When the federal government passed that law called the Health Maintenance Act of 1983, they looked at the operation of the Blue Cross Blue Shields of America, and they kind of stole their thunder. And they modeled it after the blues, because the blues were the original concept that became HMOs and PPOs. Now, one thing you've got to get, and if you see this, you want to get it right. It's called Blue Cross Blue Shield, but Blue Cross pays the hospital, Blue Shield pays the doctor. And I don't know, the one way to remember it, when I was a young man, most hospitals were run by religious organizations, so there were crosses at the top of them. So I think of Blue Cross Hospital, Blue Shield, you shield yourself from the doctor, okay? Blue Shield. Blue Cross pays the hospital, Blue Shield pays the doctor. These are dumb questions. If you get it on the test, you want to get it right, dumb or not. But remember we talked about HMOs as prepaid plans? Well, guess what? The blues were the original prepaid plans. Remember we talked about HMOs, operating in service area? Well, the blues were the original service. There's about 17 to 20 service areas across the country. Blue Cross Blue Shield is different depending upon what service area you're in. Anthem Blue Cross Blue Shield that is common to our state is much different than the Blue Cross Blue Shield that's up in New Jersey and New York. Same label at Blue Cross Blue Shield, but it's got a different front name. Anthem here, maybe something else up there. So they're like franchises. I don't want you to get all hung up here, but it's like a franchise. So they get to use the name Blue Cross Blue Shield, but they have 17 or 18 different, think of them as territories, service areas. Now, the blues came up with a kind of unique thing when it comes to renewals, renewing a policy. See, under the HMO system, the blues wanted, and the blues came up with this idea. The Health Maintenance Act wanted to separate the rating system for individual policies from the rating system from group policies because of the risk factor. Separating pools of risk is a smart thing, okay? Which is one of the things they didn't do with the Affordable Care Act. They dumped everybody in the same pool, which was a dumb thing. But anyway, so what you'll need to get out of this next few minutes is, what is the difference between what we call community rating as opposed to experience rating? Well, experience rating is based upon the claims experience. That's what we talk about. What kind of claims experience was incurred over the course of the year. And it only applies to group insurance. So with group insurance experience rating, the insurance company has the right to annually review each contract with each group it's covering. And if it wants to, it can drop any group or not, or raise the premium on one group as opposed to not raising a premium on another group. On the other hand, community rating is for individual policies. And individual policies, insurance companies cannot review on an annual basis. You'll see insurance companies are much more restricted here. So they can increase premium, but only by class. We talked about that when we talked about guaranteed renewable. When we have a policy that's guaranteed renewable, that means they must renew the policy without regard to your health. However, they can increase your premium, but they can't choose you just to raise your premium. They can only increase the premium based upon the class you're in. We might not have covered it to the degree I'm just talking about it. So what's a class? Well, the age bracket you're in is a class. As you move from one age bracket to the next, you move to a different class, so they can raise your premium as you get older. Or they may raise the premium on all men or all women, all plumbers, all insurance agents. They just can select out one person and say, yeah, we're going to raise your premium. We're going to guarantee you the right to renew this policy, but we're going to raise your premium to $60,000 a month. Well, that effectively blows them out. So understand they cannot indiscriminately raise premium here the way they could raise the premium on the experience rating. So individual policies, community rating, group policies, experience rating. The other type of managed care plan is called point of service plan. Point of service plan. It's nothing more than a combination HMO PPO. Combination HMO PPO. Where an employee, usually these are group plans at work, but don't have to be. The employee might have a plan at work that allows them to treat it either an HMO or a PPO. If they're home near their primary care physician, it might be better for them financially to go to their primary care physician. But if they're out of the area, they can find a doctor who, if they want to see a doc, and it'll be treated as a PPO. So they have more options, So the member can treat the plan as best suits them. One of the things that I didn't cover, and I don't know why it's not there, but I want to make sure we cover it, is under an HMO. I did kind of allude to it. I want to make sure you get this. You pay premium and receive care from the HMO. You pay your premium and you receive care from that HMO. It's the same organization. Pay your premium and receive care from the same organization. And we already mentioned that they focus on what? Preventive care. But also remember, I see you a moment just now. It's not free. Preventive care is not free. It's what? No additional cost. One of the other highlights I want to make sure you get is how the doctors get paid. Within HMO, the physician's paid a what? A capitation fee. And with the PPO, the physician's paid, oh golly, I'm trying to do this quickly, but I'm making a mess of it. A what? A fee for service. Those are distinctions that may help you when it comes to the test. How does the doctor get paid? Okay. All right. Let's talk about medical savings accounts. Let's see where we are in it. Yep. Okay. So you should be somewhere on page 38 in your slides. Moving through this mess. We're doing good. Medical savings accounts. These are unique types of savings accounts established by employers with the purpose of helping employees pay for medical expenses that are not covered under the policy they offer. So these are employer-funded plans. Employer-funded plans. Here's what happens. We discussed this, visualize this for a minute. Just visualize along with me. Earlier today, just a little bit ago actually, we talked about deductibles, where the higher your deductible, the lower your premium. So an employer may buy a high deductible health plan for his employees, high deductible health plan, that would save money in premium. But here, instead of putting the money in his pocket, he takes those savings dollars and he drops them into this medical savings account for the express purpose of providing funds to his employees to help them pay for medical expenses that are not covered under the plan, which might include the higher deductible. They might even drop his vision and dental from his health insurance policy, which saves him some premium dollars. And those premium dollar savings end up in the medical savings account. And because not everybody's going to need glasses and contact lenses and dental work. So only those are needed, so they can be paid for. That can be paid for out of the medical savings account. So there's an advantage here to the employer because that pot can get big enough. See, when you give money to an insurance company, if you don't fully utilize that plan, and hopefully you don't because you don't get sick, but that money's gone. The insurance company just says thank you. But if you take and reduce your premium by having a higher deductible, those dollars are in your pocket. And if you save those dollars for some future need, Now you've got them to use if you need them, but you got them if you don't need it as well. It's the reason why we have options to have higher deductibles. So employer funded. This is only for small employers. Make a note. Only for small employers. And here's your definition of a small employer. Any employer that has between 2 and 50 employees. Okay? A small employer is any employer that has between 2 and 50 employees. That's the kind of company that can have a medical savings account. So as I said, the employer would go out and buy a high deductible health plan and then fund the medical savings account with the dollars he saves or she saves. And the employee can use the account to pay for medical expenses not covered in the policy. Sometimes a question pops up about, well, if the employee leaves, does he get to take any money with him? No, it's not their money. It's the employer's money. So they don't get to take any with them. It's not theirs. Because the balance in that fund, in that account, rolls over from year to year. And at some point, that pot could get big enough where the employer might be able to cut back on his funding and put that money in his pocket. Nothing wrong with that. Now we're going to move on to a different kind of account called a flexible spending account. A flexible spending account, some of you may have an experience with a flexible spending account, where an employee elects to have their salary reduced by a certain amount of money on every pay period, and those dollars are placed into this account. It's called a flexible spending account. The benefit to the employee is they get a tax break. The money they put into that flexible spending account is not taxed as income tax. They save Social Security tax dollars on it. It's a pretty good deal. However, it's use it or lose it. What happens with flexible spending accounts is usually October or November of every year, employees are running around buying eyeglasses or contact lenses just so they can make sure they don't lose the money. That's just the design of the plan. Now, whenever an employee agrees to have a certain amount of money come out of their paycheck into the flexible spending account, they cannot make a change to that election just because they feel like it. They have to wait until some specific point in time. One of those would be their hire date anniversary. Now they can make a change to their deduction. Or if the company they work for establishes an open enrollment period, they'll say, okay, in July of this year, we're going to have an open enrollment period where people can make changes to their flexible spending accounts. Or, I don't have this down, or if they have a life-changing event. Life-changing event. Well, let's think about what would be a life-changing event. How about marriage? Birth of a child? Something like that. At that point, they could make a change, but not willy-nilly throughout the year just because they feel like it. Health reimbursement accounts, different than the other two. A health reimbursement account, there really is no insurance policy here. This is kind of what I would refer to as a self-funded insurance policy, where the employer is taking the risk of paying his employees medical expenses by establishing an account to reimburse employees for their medical expenses. So the employer funds an account to reimburse employees for qualified expenses. It's treated like a health insurance policy for tax purposes. So the employer can deduct the cost of the funds he places in the HRA as a tax deduction, just like they could for the medical expense policy if it was a medical expense policy. And if the employee needs the money for a qualified medical expense, there's no tax consequence because it's a medical expense. And the balances roll over from year to year. Any size employer can have a health reimbursement account. So one of the challenges sometimes on the test is what is one of the difference between a medical savings account and a health reimbursement account. And what I did in my head, I do things a little weird, but it helps me remember stuff. I play little games in my head to create relationships. So I use the word medical beginning with the letter M, and I think of mini, medical, mini, small employer, medical, mini, small. Health reimbursement account, any size employer. That's how I separated it. You do whatever you think is necessary. And once again, because it's the employer's money, not transferable to a new employer. Okay. Health savings account. Now, health savings account's a different animal even than the others. These are awesome. I love health savings accounts. I think they're awesome. I believe you're going to hear a lot about health savings accounts as this debate about the changes to the Affordable Care Act move forward. And I don't want to get too deep into this, but you need to become a student of our business because it's your business too. The more skin somebody has in the game, the more they're going to pay attention. The equation I like to use, the example I like to use is this. It's a lot easier mentally if I'm taking my family out to dinner and the bill comes to $100 to give them a piece of plastic and sign a piece of document with a tip than it is to peel off $120 to include the tip in cash. I can see the money get spent. It has a different impact on me when I spend the $120 in cash than when I put it on a credit card. And the way health insurance has been going since the Health Maintenance Act of 1973 is that nobody sees the money get spent. So people are less careful, I should say, about how they spend that money, including patients. So when we can move to a more of a situation where patients see the money get spent, yeah, they should get good health care and when they need it, but only when they need it and not just go because they got a toe pain. So medical health savings account helps bring skin in the game where the patient has money in the game. They have money that's theirs that they would use to pay for medical expenses, but they have some tax breaks to get this plan. That's really great. Health savings accounts, first of all, anybody can have one. They're linked to a high deductible health plan. High deductible health plan. The idea would be the higher the deductible, the lower your premium. Then you take the savings and you drop it into this health savings account. I have a quick example. I have a customer here in Williamsburg. When I met him a few years ago, he was like 62. His wife was 60. They were paying $900 a month for their health insurance. This was before the Affordable Care Act. He was paying $900 a month. And he was tired of it. He says, I'm not going to the doctor that much. $900 a month, I'm throwing away a lot of money. He said, do I have some options? And I presented the health savings account idea to him. He said, this is great. So the higher my deductible, the lower my premium. I said, yep. He said, how high a deductible can I get? I said, depends upon how much you can afford. He said, I can afford pretty much anything. I just don't want to pay $900 a month to the insurance company. I said, well, I have a company that provides a $10,000 deductible for you. Wow, what's my premium? Premium drops to $300 a month. He said, I'll take it. So his premium went from $900 to $300. What did he do with the $600 savings? Did he go out and have beer with it? No. He put it into an account called the health savings account. So it's there for him if he should have a problem and need more money to pay his medical bills. He planned for the eventuality he might have a medical bill. What a concept. Not wait until the horse is out of the barn before you close the barn door. What a plan. How about that? So now, in the course of a year, $600 a month, that's $7,200 he's got in the bank. I think it's 7,200, 612. Yeah, it's $7,200 he's got in the bank. Not bad. And he gets a little debit card, and if he needs to go to a doc, he swipes his debit card. He's already prepaid for a lot of that stuff. Anyway, linked to a high deductible health plan. Premiums are tax deductible, just like all health insurance. We went over that. Medical expense premium being tax deductible. But here's another beauty. Health savings account. The contributions to the health savings account are also tax deductible. That appealed to him a lot. He was able to take a major portion of his deductible that he was paying out of his pocket and get a tax deduction for it. And any interest he earned on the money in the savings account was earned tax-free. So there's some real tax advantages to having a health savings account. People who know how they work love them. And there's no taxes or penalties if you use that money for qualified medical expenses. Health savings accounts. Okay, we're getting ready to move into disability income insurance. Disability income insurance. This is a different animal than medical expense insurance. It's 1219. Rather than push till 12:30, let's go to lunch about 45 minutes. So 12:19, about 1:30, right? 12:19, let's say 12:19. I can't do the math in my head. 12:30 to 1:15. So about 10 after 1. Let's get back here about 10 after 1. That should be plenty of time. 12:19, but 10 after. Let me make it easy on everybody. Quarter after 1, let's be back. I'm going to give you a little longer lunch. I don't think that'll be a problem. Don't eat too heavy. If you eat too much, you're going to get what I call food coma kicking in about an hour after lunch. Don't eat too heavy. Just grab something light and get back. So about quarter after 1, you'll see I'm back, and my screen will be up, and I'll be up, unless there's a question. Does anybody have a question before we go to lunch? Okay, no problem. All right. See you about quarter after 1. Have a good lunch. Insurance. And disability income insurance is designed to replace income of a breadwinner. So as it says, it's designed to replace earned income. And earned income being defined as income from a job, not investment income, income from real estate holdings. That's not the kind of earned income they're talking about. It's the kind of income that if you don't show up, you don't get it, you don't get paid. That's what we mean by earned income here. So that's what disability income insurance is designed to replace. These policies have 3 basic elements. There's a benefit amount, how much you're going to get each month. Usually it's paid monthly. And it's tied to income. There's a limit on how much somebody can get based on their income. There's a benefit period, which is basically how long they're going to get that money after the elimination period, which we're going to talk about in a second. And the elimination period is like a deductible in regular health insurance or medical expense insurance, except you measure it in time rather than dollars. So an elimination period, we would say the longer the elimination period, the lower the premium, as opposed to the higher the deductible, the lower the premium. So elimination periods are measured in time rather than dollars. And once the elimination period is satisfied, then the benefit period begins. And how long that benefit period lasts, 6 months, a year, 5 years, 10 years, will be determined when the policy is purchased. These are sold to both individuals and groups. The big difference between individual policies and group policies across the board, whether they're traditional health insurance, medical expense insurance, or disability income insurance, the underwriting is a little bit easier. It's for group policies, it's a little more liberal on the group side. When they have individual policies, the underwriting is a little more restrictive. They require a little stronger medical underwriting requirements. So, but other than that, disability income is disability income is disability income. So let's talk about the benefit amount. On an individually owned, as opposed to group, individually owned disability income policy, the benefit amount is generally not allowed to exceed more than 70% of a person's earned income. They want to keep it lower than they take home. They don't want a person to stay home having more money come in the door than when they're working. So they limit it to no more than about 70% of their earned income. Once again, the elimination period is the deductible we measure in time rather than dollars, and no benefits will be paid until the elimination period is satisfied. The benefit period, of course, the longer your benefit period, obviously, the higher your premium. That's how long you're going to receive your benefits once the elimination period is satisfied. So all of these factors are available to the owner when they buy the policy. Different insurance companies have different restrictions, but by and large, the owner gets to pick and structure this that best suits them. Now, these two may show up on the test very specifically. The difference between a long-term disability contract and a short-term disability contract. And as you can see, a disability contract that has a benefit period of a year or less is called short-term. One that has a benefit period of 2 years or longer, they're going to call it a long-term disability contract. Just a line in the sand that somebody drew that you may need to remember for your test. In the real world, nobody really gives a rap whether you call it long-term, short-term, intermediate term, or part. They don't care. They just want to know what they're getting. But that's the issue that might appear on the test. Injury. We can become disabled, as you probably well know, because we get injured. We get disabled because we're sick. Now, injuries, depending upon the company, the definition of an injury can be different. One insurance company might use what's called the accidental bodily injury definition, and another insurance company might use the accidental bodily injury caused by accidental means definition. So here's the difference. If I have a disability income policy that uses the accidental means definition, and I'm going to change a light bulb on my porch, and on the way down of the ladder, after I've changed the light bulb on the way down, I jump from the third rung and I break my ankle, my policy is not going to pay me a benefit. Well, not because the ankle break was an accident, because that's obvious that was an accident, but I jumped. That was not an accident. The means or the cause of the accident was not accidental. If a rung of the ladder breaks and I break my ankle, now I have accidental injury caused by accidental means, and my policy will pay. So the accidental means definition is a more restrictive definition, tougher to get paid. On the other side of that coin, however, the accidental bodily injury definition is a more liberal definition. Insurance company has a greater exposure, and their premium, all things being equal, the premium for accidental bodily injury is going to be higher than the premium for accidental means. All things being equal in the policy, other than that, those two definitions, the accidental bodily injury definition is going to have a higher premium. If you ask someone which one they prefer, most people would prefer accidental injury if they understood it. But when you tell them what the premium is, the difference in premium, they might prefer to have the other. Anyway, that's not going to be on your test. I'm just trying to make sure you understand what is the difference. And one way to remember this, if you haven't already gotten it, is to think of it this way. Means is meaner. Means is meaner. It's a more restrictive definition. Now, typically speaking, with disability situations, when someone is collecting a disability benefit through an insurance company because they become disabled, the insurance company just doesn't set it and forget it. They want to make sure that the disability is ongoing. So every so often, every month or two, they will make you go to a doctor to check you out to make sure you're still disabled. And if they determine you're not disabled, they're going to pull the benefits on your policy, and you're going to have to go back to work or something. However, if someone is classified as being presumptively disabled, the insurance company will waive the requirement for periodic checkups. So here's the definition of a presumptive disability. Total and irrecoverable loss of sight, hearing, speech, or the loss or loss of use of any two limbs. That's pretty serious stuff. So if someone is so unfortunate as to be disabled, what fits that definition, the insurance company is going to waive its right to do medical evaluations to see if you're better, because they've made the assumption it's not only total but irrecoverable. Irrecoverable is permanent. So that's the idea there. Now, when that happens, should that happen, then the insurance company is going to take a unique action. I want you to kind of stay with me here. Let's assume we have a disability income policy that's going to pay our client $1,000 a month for 60 months. And let's assume it has a 30-day elimination period. And typically, our customer gets disabled. Typically, you're going to have to be disabled for 30 days. And on the 31st day, they begin to accrue benefits under the contract. And if they're disabled for 30 days beyond the 30-day elimination period, they're going to have accrued $1,000 and they'll get a check. And every month thereafter, they'll get a check for the maximum benefit period up to 60 months. However, if they fit the definition of presumptive disability, then the insurance company is going to just write a lump sum check for $60,000. The test may refer to that as the full benefit. If someone fits the definition of being presumptively disabled, the policy will pay the full benefit, whatever that is. Some people say, oh my God, why? Well, two reasons. Number one, the reason they pay a check on a monthly basis for those who are not presumptively disabled is that there's a possibility they may recover. Under presumptive disability, they've made the determination that they're never going to recover. And it's frankly, in the long run, less expensive for an insurance company to just write a check than it is to pay a check every month. When it comes to total out costs, it's better for them to have it be done with it. That isn't going to come on your test, but people ask me that question in my live classes. So understand what we mean by the lump sum. When does that occur? That occurs when someone is presumptively disabled. Presumptively disabled. Recurrent disability. Now, that's not definable the way presumptive is. Recurrent, if you see a question about recurrent, I want you to think of with the word relapse. Reoccur, relapse. So here's a typical example. Let's assume we have an individual that's earning $5,000 a month. They buy a disability income policy with a benefit amount of $3,000. They selected a 30-day elimination period and a 5-year benefit period. That's the premise. Let's assume they've had a heart attack and they're out for a year. One of the questions might be, how many months benefit will this person have collected? Now, I don't know if that number shows on your slide. It probably does. It's 11. And how did we get 11? Well, that's that 30-day elimination period, right? They're out for the year, but the first month they didn't get paid. So that means they've got 49 months left of the 60 they started with. Here's how this relapse or recurring thing works. Let's assume after the year is up, he's recovered, goes back to work, and within 6 months has a similar or related event. Another heart attack or a stroke. They're going to treat that as a relapse. And what they mean now is it's going to be considered to be a continuation of the original disability. Good news and not so good news. Good news is he doesn't have to go through the elimination period again because it's a continuation of the original. The other side of that coin is he used up 11 of the 60 months, so it means he's got 49 left. So the concept of residual reoccurring disability is not a kind of disability at all, is it? It's got to do with how they deal with somebody who gets disabled, goes back to work, and has a relapse. That's called recurrent, okay? Now, if it's more than 6 months that goes by after they go back to work from the year, then it's all reset. Everything is new. New elimination period, new benefit period. So within 6 months or less, it's a relapse. Or more than 6 months, it's a new disability. Probationary period. This concept of probationary period can get confusing because you have to read it in context. You have to make sure you understand in which context they're asking you about probationary period. Because here's the issue. When you go to work for an employer, if they have group health insurance, there is usually a probationary period. Somewhere between 60, maybe less, to 90 days that you must work for that company before you become eligible for any group benefits. That's one use of the word probationary period. What we're going to discuss is not that use. This probationary period is imposed by the insurance company for disabilities caused by illness. So when a new disability income is purchased, when a disability income policy is purchased, think of it this way. We're on probation for any disabilities caused by sickness for the first 30 days. The probationary period only occurs once at the beginning of the contract. Once that's done, it's done. Elimination periods occur every time there is a new disability. So don't confuse elimination periods from probationary periods. They're different. They deal with different things. So the probationary period we're going to talk about now is the probationary period that's imposed by insurance companies for disabilities caused by illness. So again, it's a one-time period of time. It begins when the policy is issued. So the phrase we use is it's in addition to the elimination period, because when the policy is first issued, you'll always have that probationary period you must go through before you can even begin to think about getting any benefits. And it only applies to sickness. And it runs for 30 days. So why do insurance companies have that? That's to help eliminate adverse selection. Because I want you to consider this. Seeing as how they don't do medical exams for health insurance, they don't really know if you got a problem. And you might find you get a diagnosis from a doctor that says you got to come down with a pretty debilitating sickness in the next couple of weeks. You say, man, I better get some insurance to cover me for my lost wages. So you go out and buy the policy. Well, you're not going to get any benefits for any disabilities caused by sickness for the first 30 days that contract's in effect. They're just not going to do it. That protects them against someone who might fall into that situation. Protects the company from adverse selection. We got this slide in there twice. I got to get rid of it. We've already been through that. Now, there are some business uses of disability income insurance. Reasons why businesses might want to use disability income insurance. Most of what we talked about has been personal use. We're now talking about business uses. And one of them is called business overhead expense insurance. Called business overhead expense insurance. Now, I gave you a little outline earlier before lunch about tax deductibility of premiums. And if you either look back or think back, I said to you, whenever the payer and the receiver are different, then the premium is tax deductible to the payer, and the benefit is taxable as income to the receiver. But if they're the same, if the payer and the receiver are the same, then the payer does not get any tax deduction and the recipient pays no tax on the money. Well, with business overhead expense insurance, the premium is tax deductible because the business owner pays the premium. And if the business owner gets disabled, his company is going to get the money. So the payer and the receiver are different here. The business owner pays the premium, so his business can get the money if he gets disabled to help the business pay its overhead expenses, which creates taxable income to the business, just as if he was working and creating income to the business. Then we have what's called disability by cell. Disability by cell. This is for partnerships primarily. Let's assume we're all partners in a business. I haven't done a head count, but I think we may have 6 or 7 people. Let's assume we have 7 people on the call. And let's assume we're all partners in a business. We would have, most likely, if we were smart, sat down with an attorney before we got too far down the road and drawn up a document called a buy-sell agreement, where we would incorporate in that document the terms and conditions we will abide by should we decide to break up our partnership, or if one of us gets disabled, or if one of us dies. How are we going to handle that circumstance? Well, we're going to focus on this test for the disability issue. And if one of us gets disabled, the question is going to be, how long are we going to allow that disabled partner to remain a partner in the business if they can no longer participate in the business? So we're going to have to set some guidelines, and we'll do that in this thing called the buy-sell agreement. We do that so that we can buy out the disabled partner at some point, because the disabled partner may even force us to give him the money and buy him out. And in that case, if we don't have the money, we have to liquidate our partnership. So to avoid all of that, we enter into this agreement, and that puts the numbers down on a piece of paper. And then we would go to an insurance company and purchase a disability income policy in the event one of us gets disabled. Now, the process is what the test question is about. With disability by cell insurance, premium is not tax deductible and the benefit's tax-free, because as you're going to find out, the same outfit that whoever buys the policy is going to receive the benefit if somebody gets disabled. So here the buyer and the recipient are the same, so the premium is not tax deductible, the benefit's tax-free. And the same is true with key person disability insurance. Key person disability insurance is where a company will insure a person who is so valuable to the company that if we lose their services, we have a financial loss. There's a negative financial impact on the company for the loss of that person's services. So the company would buy, pay for, and receive the benefit on a policy if the key person becomes disabled. So now the premium payer is the company and the receiver is the company. So the payer and the receiver are the same. So with disability by cell and key person, the rules are the same. Premium is not tax deductible, benefits tax-free. The only one that's different is business overhead expense, where it's the opposite, okay? So let's take them apart one at a time. BOE insurance, that's obviously not the benevolent order of Elks. Business overhead expense insurance. It's only for small businesses. Now, do not confuse small businesses with a small employer. Two different things. Small employer we define as an employer that has between 2 and 50 employees. To get group insurance as an employer, you got to have a minimum of 2 employees. And any employer that has between 2 and 50 is called a small employer. It's not what we're talking about here. Small business is the kind of a business that depends upon the business owner generating the income to pay its expenses. So let's assume I'm a landscaper and I have equipment that I finance through a bank. I have a small office that I pay for, got rent, phones. I have a woman that comes in once a month or twice a month to help me with my billing. I have to pay her. If I become disabled, grass doesn't get cut, no money comes in. So I might buy a BOE policy to provide dollars if I become disabled. Dollars for what? Dollars to pay those business expenses. Well, because I can't generate the income. So because the payer is the business owner and the recipient is the business, premium is tax deductible, benefits taxable. If the owner becomes disabled, it's going to pay overhead expenses like a rent and phones, utilities, employee salaries, Be careful, however, it does not pay the employer's salary. The employer's salary is not considered to be an overhead expense, business overhead expense policy. Disability buy-sell. There are two ways to get this done. One way is to have the partnership pay for the premium, buy the policies to pay for the premium. The other way is to have each individual partner buy a policy on the other partners. Let's assume we have, just make a round number for me. Let me make a round number. Let's assume we have 10 partners. Let's call it the lucky 10 partnership. We might decide that we got this buy-sell agreement and it's in place. Now we have to buy some insurance to fund the terms of the buy-sell agreement. So one way we might do it is have our partnership, the lucky 10 partnership, buy a disability income policy on each of our 10 partners. The amounts and the elimination periods and the benefit amount, all that, we thrash that out in the buy-sell agreement. So what will happen, the partnership pays the premium. If one of us gets disabled, the benefit's going to buy out the disabled partner because the partnership's going to get the benefit. Partnership pays the premium. If a partner becomes disabled, the partnership gets the benefit. So the payer and the receiver are the same. These have long elimination periods, at least a year, sometimes 2. Because I don't know about you, but I know about me, I wouldn't want the rest of you to be able to buy me out just because I'm disabled for a month or 2. Okay? And I'm sure you'd feel the same way. So we put long elimination periods on these to make sure it's really something that's going to need to be done. And again, it's a lump sum payout. We don't pay the partner out monthly. That's how we buy out the disabled partner. A second way we could do it, it's the same end result, which is what's called cross purchase, where we have 10 partners, each buying 9 policies. You don't buy one on yourself. So each partner buys a policy on the other partners. Benefits will be used to buy out the disabled partner. Again, long elimination periods and a lump sum buyout. So whoever buys the policy, whoever's the owner, either the entity or the individual partners, if one of the partners gets disabled, whoever bought the policy is going to get the benefit so that we can then buy out the disabled partner. Entity purchase, cross purchase. Key person disability. Key person disability. This is where the company pays the premium, owns the policy, and will receive the benefit if a key person becomes disabled. I just gave you the definition of a key person. That's a person, if we lose their services, the company's going to suffer a financial loss. Obviously, we can't get this done without that employee's signature, but once we get the signature, it's valid because we have insurable interest because of the financial potential loss. Once again, the company's paying for it, company's getting the benefit, payer and the receiver are the same, not tax deductible, benefits not taxable. AD&D. This is not ointment you put on a baby's butt when they have a rash. It's not attention deficit disorder. It's a unique kind of policy called accidental death and dismemberment. Accidental death and dismemberment. So it'll pay a benefit if somebody dies by accident or accidentally loses a limb. That's what dismemberment means, a limb, L-I-M-B, a limb. These can be sold as a standalone product, or we very often add them as a rider to a full-blown disability contract. So now, this is just a lesson, an exercise in semantics. If that AD&D policy pays the full amount, they're going to call it the principal sum. If it pays out less than the full amount, they're going to call it the capital sum. So how might we arrive at that issue? Let's go this way. Let's assume that somebody buys a $10,000 AD&D policy. So what does that mean? If they die by accident, the policy is going to pay $10,000. If they lose a limb, the policy is not going to pay out $10,000. They're going to pay a portion of that $10,000. We got 4 limbs, so let's assume $2,500. So now, if they die by accident, the policy is going to pay out $10,000. That's the full amount. We're going to call that the principal sum. If they lose one limb as a result of an accident, the policy is not going to pay out the full amount. Maybe I'm just guessing at a number here, $2,500. It doesn't matter the number, it matters the point. That is less than the full amount. So they're going to call that the capital sum. Now, one more, there's another possibility. Let's assume they lose 2 limbs accidentally. The policy is going to pay out the full amount. We just did that. Presumptive disability. So the policy is going to pay out $10,000. They're going to call that the principal sum. You have to read the question carefully. If the policy pays out the full amount, it's called principal sum. Policy pays out less than the full amount, it's capital sum. And it pays the full amount if you die by accident or lose 2 or more limbs. In other words, you become presumptively disabled. Long-term care insurance. Long-term care insurance is a different animal than the other things we've been talking about. Most of what we've been talking about has been health and medical expense insurance to provide money to help us pay our medical bills, where we might need, I'm going to go over here to this worksheet again, where we might need what is referred to as acute care. Acute care. Nothing cute about acute care, other than the nurses perhaps, and for the ladies perhaps the doctors. But acute care is the kind of care that you must get on a daily basis by skilled medical professionals under the orders of a doctors. We're going to cover acute care, but most of the medical expense policies we talk about, HMOs, PPOs, those traditional plans we discussed earlier this morning, those are all acute care payers, okay? Long-term care insurance doesn't provide any benefits for any kind of quote-unquote acute care. It provides benefits for somebody who needs what's called custodial care. Custodial care. We're going to define that in a minute. So let's go back to my slide. Long-term care insurance policies can be sold as a group plan, or they can be sold to individuals, or they might be added as a rider to a life insurance policy. What's a rider? Well, a rider is something that sits on something, so it's just attached to. Riders need something to sit on or in. If they don't have something to sit on or in, they're a pedestrian, and we don't have pedestrians in insurance. So long-term care policies can be sold as a rider to a life policy, but usually they're sold to individuals. Now, second bullet, a long-term care policy must provide for benefits that will last at least 12 months. Must provide benefits that will last for at least 12 months in a setting other than the acute care unit of a hospital. In a setting other than the acute care unit of a hospital. Because remember, acute care is going to be covered by your medical expense policy. This is somewhere else. So long-term care policies are designed to pay up when you can no longer live an independent lifestyle. You need help with what are called the activities of daily living. So the triggering event to get a benefit out of long-term care is the need for what I mentioned a few minutes ago called custodial care. We're going to define that level of care in a minute, but give you a good idea. Custodial care is the kind of care parents provide infants. Infants can't do anything for themselves. They can't bathe themselves. They can't feed themselves. They can't clean themselves up when they make a mess at either end. They need mom or dad to do that. That's custodial care. They need mom or dad to carry them around, put them in places. Well, on the other end of the life cycle, that could happen. There's a saying, it's called, once a man, twice a boy. I mean, it can happen. So when you become older and need help with those things, Mom and dad are gone. People charge you money to do it for you. So that's what long-term care is about, custodial care. Now, that last bullet you see, it says long-term care will cover skilled care, intermediate care, and custodial care. But there's a criteria here. Criteria. Let me give you an example, and hopefully this will make sense. If it doesn't, ask me. Let's assume mother has Alzheimer's, and she has a long-term care policy. Now, because she has Alzheimer's, she cannot live an independent lifestyle. So the policy is going to start to what I refer to as trigger a benefit. She's going to get a benefit out of that policy, kind of like disability income. She's going to get a check every month. For what reason? To pay somebody, to help her with the things she can't do for herself. But it is also possible that while she's in Alzheimer's, she might fall and break her hip. Well, if she falls and breaks her hip, she's going to go to a hospital, need an operation. She's going to need acute care. Well, her need for custodial care doesn't go away just because she broke her hip. And the hospital is not going to have a nurse sit by her bed 24/7, 365. Not going to happen. So her long-term care policy would continue to pay her so that she might be able to bring somebody in to help her when the nurses aren't there to help her. So it will cover skilled care and intermediate care, and we'll talk about intermediate care in a minute, if the triggering event was a need for custodial care. That's what I was trying to drive at. So my example was she was already collecting benefits for long-term care, then subsequently she needed skilled care, so her policy continues to pay. So let's redefine. Let's make sure we define these ideas. What is skilled care? Skilled care is defined as care that is needed daily. Must be provided by skilled medical professionals under the orders of a physician. That's typically what we call acute care. Intermediate care. It's the same as skilled. I just noticed a spelling error. Every time I go through this, I see another spelling error, and I want to fix it. It's the same as skilled, except other than daily. So it's not quite as frequent. Custodial care, on the other hand, occurs when someone can no longer take care of themselves. They have lost the ability to perform at least 2 or more of what are called the activities of daily living. And anyone can provide that care. You don't need a special license to help somebody bathe or to help feed them, okay? So those are the 3 levels of care we've talked about. What are the activities of daily living? There are 6 of them. Eating, bathing, dressing, transferring, continence, and toileting. If someone cannot, without assistance, perform 2 or more of those, and if they have a long-term care policy, that policy will trigger a benefit. Then they can use that money to pay someone to come in and help them. So it's got nothing to do with acute care. It's got to do with custodial care. Any questions about the activities of daily living? Okay, great. Definition, home health care. Let's define home health care. Home health care is care obviously provided in your home. Occasional visits, medically necessary, licensed professionals. Sounds a little like intermediate care, doesn't it? Well, it is, just so you get it, okay? Home convalescent care, another definition. This is care provided in your home, but this is your key phrase. It's a planned program of recovery established by an attending physician. That's home convalescent care. So mother falls and breaks her hip. She goes to a hospital. They fix her hip, put a new hip in. Normally, she would go to a nursing home, convalescent home, another way to say it, where they would teach her how to walk again. But doc might say, hey, Mary, you got all that equipment at home. We'll just send you home if you like, and we'll send somebody from the nursing home or from the hospital to see you once every day to make sure you're going through your exercises. That's all that is. Okay? These will be provided by one of those organizations. So you don't go to them, they go to you. That's home convalescent care. Then we have residential care. Got to be careful with this one. Residential care, you're no longer at home. You're in a retirement community. Now you got to get the same kind of care as we discussed under home health care, with one exception. You have access to full-time care if needed. There's usually a nurse on staff 24/7, 365 who has access to physicians that are on call. So residential care is retirement community care. Adult daycare. Well, if you understand daycare for kids, you understand daycare for adults. You know, not normally, but a lot of times you have some senior citizen who can no longer help themselves and they're being cared for by an adult child. But that adult child is working. We have to leave them alone. So we can't say, hey, mom, don't go to the bathroom till we get home. But drop them off at a daycare center so they can be tended to and watched until we come home from work. Got a role reversal here, huh? So they also refer to it as community-based care. No overnight stays, for much like what? Daycare for kids. Respite care. The word respite is unique. Respite. If you look it up, you may already know what this means. It means take a break. Well, the patient never gets a break. So on your test, if you get any question about respite care, it's revolving around the fact it's a benefit for the caregiver. Let's go back to the adult child taking care of an older parent. After a while, they just burn out. They might need some help. They need a break. So what we might be able to do, if you have respite care and long-term care policies automatically provide this, we could drop mom or dad off at a facility for 3, 4, or 5 days while we take a break. Or an insurance company might pay extra money to bring somebody in to take care of mom or dad while we take a break. I mean, it doesn't pay for our vacation, but it pays so that we can get away and mom and dad will still be cared for. So how do they work? What do they look like? Well, they look a lot like disability income policies. They have a benefit amount, daily or monthly. Now, it says selected by the customer. That's kind of true, but not necessary for the test. Here's the point. Some insurance companies sell these long-term care policies where the customer gets to pick a daily benefit, 100 a day, 200 a day, 300 a day, whatever they want. And for every day they get care after the elimination period, they'll collect that whatever amount per day that the policy says. Some policies will pay a monthly benefit, $3,000 a month, $3,500, $4,000, $6,000 a month. And if a person needs long-term care, they get care 1 day in the month after the elimination period. The company will write a check out for that 1 month's benefit, and then the patient must make that money last for all the care they need during the month. There are two different ways of doing it. So it's daily or monthly. They have elimination periods, just like disability income policies, but how they calculate the days is different. If you think about it, an elimination period is a period of time that you have to suffer through, so to speak, before you begin to get any benefits out of your policy. So the faster you get through that, the better, happier you're going to be. Well, the elimination periods of long-term care policies can be one of two different ones, and insurance companies will make the decision as to what's in their policy. So here, let's talk about service day. A service day elimination period is not something I would want, but here's how it works. Let's assume I have a 30-day elimination period in my policy, and it's deemed to be a service day elimination period. Somebody comes in on Monday, the first day of my care, 1 day, Monday. Bang, that knocks down, I'm down to 29. And nobody needs to come back to the following Tuesday. I'm down to 28. Somebody comes in the following Wednesday. Next week, a week later, down to 27. At the rate of 1 day a week under the service day counting, it could take me up to 30 weeks to get rid of my elimination period before I get any benefits. On the other hand, oh, excuse me, I have a doctor calling me and I must take this call. Take 10 minutes. But on a calendar day elimination period, this is makes a little more sense. Calendar day elimination period works like this. If I need care one day in the week, for one day, they'll knock 7 days off my elimination period. So 1 day's care during my elimination period using the calendar day takes my 30 days down to 23. And if the following week I get another day, now I'm down another 7 days, I'm down to 16. So 1 day a week, it would take me about 4 weeks to use up my elimination period. So the difference between service day and calendar days is how fast the elimination period disappears. Service day, a day equals a day. Calendar day, a day equals a week. You might not even see a question about this on the test, but I would not be doing you a favor if I didn't at least cover it. Most people, if asked, would prefer the calendar day elimination period. But on the other hand, the calendar day elimination period, all things being equal, would have a higher premium than the service day elimination period because the company has a greater risk of paying out sooner under the calendar day than the service day. Group health insurance. Group health insurance. First of all, it's important to note, and this is a statement that is just something for you to know. Groups may not be formed for the sole purpose of buying insurance. Of course, all of this is kind of predates the Affordable Care Act, because with the Affordable Care Act, it doesn't matter. But prior to the Affordable Care Act, the only way someone who had any real medical problems could get health insurance is if they were working for a company that had group insurance at work. Because with group insurance at work, the underwriting was so much less restrictive than the underwriting for individual health plans. So what the insurance companies wanted to avoid at almost all costs was something like 10 cancer patients getting together to form a group. Now they're all going to get the insurance and the insurance company's on the hook, and they really don't want that. So that's a concept question there, a definition. There are more than 2 types of group health insurance, but the test generally revolves around these 2. The most common type of group health insurance is employer-employee. The most common is employer-employee, where employers provide group health insurance for their employees. Now, to qualify as a true group, they use the word true, T-R-U-E, group, or natural group. You got to have a minimum of 2 employees. And that would qualify as a true group for group purposes. So what's the advantage of group insurance? Well, the premiums for a comparable individual policy will be lower on the group plan than the individual plan. The underwriting for the group plan is less restrictive than the underwriting for the group plan, for the individual plan. So there's reasons why group plans are more attractive than individual plans. Now, in a group plan, the employer is referred to as the sponsor. They receive what's called the master contract. They're the ones that have a contract with the insurance company with respect to this particular policy. And employees receive certificates that prove they have coverage. Employees do not have a contract of insurance. They have a certificate that says they're part of a master contract. When a new employee comes on board, once they satisfy that probationary period that the employer says you got to work, 30, 60, 90 days, then visualize a window opens and it stays open for 31 days. And that's referred to as an enrollment period. So as long as the new employee enrolls during the enrollment period, they don't have to prove they're insurable. That's what the words no evidence mean. If they enroll after the window closes, they might have to prove they're insurable, or wait until their anniversary hire date and enroll at that time. The insurance company did not want someone to decide to enroll in the group plan just because they woke up coughing up blood one day. They wanted to make sure they were enrolling under terms that had nothing to do with their health, nothing directly to do with their health. Now, on the test, they may describe or talk about contributory plans and non-contributory plans. So let's get you a couple of factoids here. A contributory plan requires that at least 75% of the employees participate in the plan. And contributory really also means the employee is paying some of the premium. A non-contributory plan means the employer is paying all the premium and the employee is paying zero premium. So contributory, non-contributory really revolves around who's paying, huh? A contributory plan is telling you the employee is paying some of the premium. A non-contributory plan is telling you the employee pays none of the premium. Now, what I'd like you to think of it is this, think along these terms. If you get a question that uses the word contributory or non-contributory in the question, look at the answer for the percentage of 75 or 100%, because you should match up the contributory with 75% and the non-contributory with 100%. What am I trying to say? The contributory plan, remember the employee is paying something, requires that if I had 100 employees, I'm going to have to get at least 75% of them to participate in the deal. That's why they call it contributory. And I got to get 75% of them to pay whatever premium I suggest they got to pay. Now, if it's a non-contributory plan, I have to cover, as an employer, 100% of the eligible employees. So how do we know who is an eligible employee? Well, eligible employees there may be some discrimination. Discrimination is allowed. Discrimination is not a bad word. It depends on how you use it. Discrimination. So as an employer, let's assume I have 100 people working in my office. And I have 100 people working in my warehouse. I don't know if I spelled that right. I can't even remember. Anyway, so now I can discriminate based upon job classification. I can say I'm only going to cover my warehouse people or only going to cover my office people. I knew there's something that didn't look right there. All right. So I can discriminate based upon job classification. I can also discriminate based upon how long they've worked for me, which is why I can impose probationary periods. I cannot discriminate based upon age, gender, marital status, sexual preference, that kind of stuff. So you may get a question about how that eligible group that we just talked about on the slide, what do they mean by eligible group? Well, the employer selects the eligible group, but they have to be careful. They don't discriminate against somebody because of their age, their gender, marital status, or sexual preference. But we can discriminate based upon job classification. But then once I set my eligible group, I have to cover 100% of that eligible group. I just can't say all of my male office workers, okay? Can't do that. So on your test, you may see the word contributory in a question or the 75% in a question. Well, then match it to the opposite in the answer. If you see contributory in the question, look for 75% in the answer, or vice versa. And the same would be true for non-contributory and 100%. The other group that sometimes shows up on a test is called an association group. And association groups are identified by 3 factors. 1, they have to have a minimum of 100 members. They have to be in existence at least 5 years. They must have a constitution, bylaws, and annual meetings. This eliminates groups forming for the sole purpose of buying insurance, okay? And as I said earlier, the underwriting mechanism for groups is much different than it is for individual. With individual underwriting, it's a fairly restrictive scenario where everybody, both applicants and dependents, must qualify medically. They have to pass underwriting standards. And these policies are...
Lou, can we ask you a quick question?
Oh, sure, go ahead.
On the back to the association, in your slide it says 5 years. On our packet it says 2 years.
Really?
Yeah, we were just trying to clear that up.
Oh, well, let me take a look. It should be 5.
It should be 5?
Yeah.
Okay, thank you.
No, that's cool. I want to find it. Because I am supposed to have a copy of what you have in front of me. So give me a minute here. Yeah, it does say 2. Yeah, I'll make sure they're fixed from this point on. No one's pointed that out to me before. No, it's 5 years. Thank you for bringing that to my attention. All right. That's what's called proofreading, huh? All right. So the underwriting process. With individuals, it's a more restrictive process. Everybody, applicant and dependents, have to meet underwriting requirements. And what we call family policies, where we have mom, dad, and kids covered, that's still called an individual contract. Families are not groups. Even my mother's family, she was the oldest of 21 kids, same mom and dad. That was not a group. That was a gang. No, I'm kidding. All right. But applicants and dependents both must qualify medically. These policies are guaranteed renewable. Remember, we talked about guaranteed renewable. They have to renew it, but they can increase premium, but only by class. And then the underwriting process, they're looking at each person's age, their gender, their health, history, current and past, occupations, and you're looking at moral or morale risk and some other family history issues. With group insurance, it's a lot less restrictive. What we do when we take a group policy, what's called a true group, we're going to do what's called a census. We fill out a census. And dependents are not always covered and usually not covered as part of a group plan. If they are going to be covered, it's usually extra premium for them. And the insurance company looks at the general condition of the group rather than each individual. And automatic coverage when the insured enrolls when they're eligible. There's no medical underwriting, okay? If insured enrolls while they're eligible, bang, they got the insurance. So it's a lot easier, a lot less restrictive on a group. Now, if a person separates from the group, they either leave the job or whatever, they have a couple of options. One of them is to convert the group plan to their own personal individual policy. That's called conversion. And they must do it within 31 days. If they choose to convert and do it within 31 days, they don't have to prove they're insurable. Just convert. Now, most people don't because their premium goes through the roof. Because one of the other advantages of group plans, all things being equal to individual plans, is that group plans have a much lower premium per person than individual plans. Now, while they're making up their mind, they're covered during the conversion period. You have to watch this question. It's a little tricky, and I didn't word this very well. But here we go. Let's assume I'm part of a group plan, and I leave my company. I've got 31 days to decide if I'm going to convert or not. If I'm going to convert, I'm going to have to pay premium. At some point, I got to pay premium. So I might pay the premium. Let's say on the 15th day, I say, I think I'm going to convert. So I pay the premium to convert. Question: when does coverage begin for the policy for the premium I just paid? 16 days later, on the 31st day. I'm sorry, 17 days later, on the 32nd day, because I'm already covered during the conversion period. See, you're covered during that 31-day conversion period. So any premium you pay to convert is going to be paid during the conversion period, but it provides coverage once the conversion period is over. I hope that makes sense to you. The premium you're going to pay is based upon your then attained age rather than some blended age they use on a group plan. And you're going to pay individual rates, which means premiums are going to go through the roof. Most people can't afford to convert. Or the second option is they could utilize COBRA. Now, be real careful here. COBRA, what does my first bullet say? It's a federal law. It's not insurance. COBRA is not insurance. It's a federal law. I'm going to tell you what COBRA stands for as soon as I get to my worksheet page. COBRA stands for Consolidated Consolidated Omnibus Budget Reconciliation Act. It's a federal law. It's not insurance. And they may ask you, try to confuse you. A lot of people think it's insurance. No, it isn't. It's a federal law. So what does this federal law do? Here's what it does. Oh, let me get back to my slide. It says, this law says, any employer that has 20 or more employees, if they have group insurance, is required under the law to extend group benefits to that employee, ex-employee now, for up to 18 months. Now, if they're married, they still stay for 18 months. But if they get divorced, let me rephrase that. It says 18 to 36 months on your slide. It covers the employee and their family for 18 months. They got to pay for it, but it will provide group coverage at group rates for up to 18 months. However, if the employee dies, then their widow or widower and surviving children will get another 18 months availability. Okay? Or if they get divorced, their ex-spouse and dependent children can stay on for another 18 months. So the employee and their family, if they stay intact, only get 18 months of coverage through COBRA of the group plan. If there's a death, if the ex-employee dies or gets divorced, their spouse or widow or widower and kids get another 18. So the 36 is only for the surviving spouse and kids or ex-spouse and kids. It's kind of weird. They still have to pay the premium. It's not premium free. They have 60 days to make up their mind if they're going to utilize COBRA. The premium does not increase. Be careful. Some people have had experience with COBRA and they have this perception that the premium's gone up. The premium hasn't gone up. It's the same exact premium as it was before. The difference is the employer, ex-employer, is no longer paying their share. So if the employer was paying 100 and you're paying 100, you're paying 200. But the premium was always 200. So the premium didn't go up, your share went up. In addition to that, the employer is allowed to charge a 2% administrative fee for handling the premium. Because the structure of this would be the employee, a former employee, would send a check to the employer for the premium, and the employer is allowed to charge a 2% administrative fee to handling that check. COBRA. HIPAA. HIPAA is a federal law. Stands for Health Insurance, Portability, and Accountability Act. Health Insurance, Portability, and Accountability Act. Let me spell it out for you. Oops, that wasn't supposed to happen. What happened to my... Oh, here it is. So what does it stand for? HEALTH. Health Insurance. Oops, sorry about that. HIPAA, Health Insurance Portability and Accountability Act. Weird. The feds love acronyms. If any of you have done any business with the feds or been in the military, acronyms are, if you don't get the acronyms, you can't have a conversation with anybody. They talk in shorthand. But anyway, that's HIPAA. That's what it stands for. It's a federal law. So the question becomes, how does it apply on the test? Well, HIPAA provides portability by implication of the title, Portability. Whether I go from a group to a group, or I leave a group and go to buy some individual insurance, or switch from one individual policy to the other. The test is only going to talk about, if they give you any questions here, it's going to talk about moving from group to group, group to group. So here's how it works. First, let me tell you what it doesn't do. It doesn't guarantee that if I am covered by Anthem for my old company, I can bring that Anthem policy with me to my new company. That's not what they're talking about when it comes to portability. But what it is talking about, I'm going to get credit for the months I was covered under my old policy to help me use up the probationary period for the new company I go to work for. Let me explain to you what I mean best I can. Let's assume I worked for a company for 5 years, and I've been covered under their group plan for 48 months. Under HIPAA, that would mean I have 48 months of creditable coverage. Coverage I get credit for. $48 months of creditable coverage. Now let's assume I leave that company and I find a new job. And that new job has a 90-day probationary period before I become eligible for the group insurance. Well, they have to waive that because I have enough months of creditable coverage to waive that for 90 days. That's 3 months. I've got 48 months of creditable coverage. Poof, the probationary period is done. So they must cover me immediately upon hire. Number 2, group insurance, as we said, also has the possibility they can look back a year for pre-existing conditions. Well, they'd have to waive that in this case as well, because how many months creditable coverage do I have? 48. Well, that's more than 12, so they have to waive that as well. Basically, they got to cover me immediately without any regard to my health. So, limits the exclusion for pre-existing conditions, no health discrimination of any kind, and they have to give me what's called the special enrollment period, which means no probationary period if I qualify. Forget the individual, not on the test. Forget that one as well, not on the test. Nope, nope. The only thing on that slide that's important is the bottom part. Newborns are covered immediately upon birth. The minute they become a separate living being away from the mother's womb, they're covered under any policy, whether it's group or individual. While they're inside mom's womb, they're covered as part of mom. But when they come out, they're covered as a separate entity. Adopted children are treated equally to any natural-born children as well. That could be on your test. Now, under HIPAA, pregnancies are treated differently than under individual policies. We'll talk about that later. So, health insurance policies can be non-renewed or canceled. This should not come as a shock to you if you don't pay your premium. Don't pay your premium, you're done. Or fraud, but only within what? The first 2 years. And in group insurance, if the employer violates that participation percentage we talked about earlier, or the contribution rules, they're done. Or the insurance company could pull that group plan just by saying we're no longer offering that plan in this area. They have a lot of latitude with group plans. Now, this may come close to some of the stuff you guys would be selling. Cancer/dread disease policies. What goes on in the real world is not necessarily reflective of the test. Okay. When I was in college, I had a philosophy professor, and he and I never saw eye to eye on much of anything. And we argued all the time. And one day, just before my first test, he came up to me and he said, "Lou, your input is welcome. I appreciate your opposite point of view. However, when you take my test, I want my answers." So if I expected to pass his test, I need to give him his answers. Well, give him their answers. That's what I'm trying to say here. So here's the distinction between these policies. They're both limited risk policies. All limited risk policies cover some specific problem, like cancer, heart disease, hospital confinement. Now, any policy that's referred to as cancer or limited risk policy will have a schedule of benefits. That last line up there, schedule of benefits. In other words, it's like a menu. It'll tell you exactly what you're going to get paid for what. $50 for a doctor visit, $100 for chemotherapy, whatever. $100 a day, $200 a day for every day you're in the hospital, that kind of stuff. But there's a difference between cancer dread disease policies and critical illness policies. See, cancer dread disease, the key element here is a schedule of benefits. Critical illness, there's a lump sum payout upon diagnosis. That's your key. Some cancer policies, upon diagnosis of internal cancer, will pay out a lump sum benefit of $5,000 or more dollars. So on the test, the difference between cancer/dread disease policies and critical illness policies is scheduled benefits for cancer dread disease, lump sum payout for critical illness. If you lock into that, you should not have any problem with the question if you see it. Workers' comp. Workers' comp will pay benefits only if the injury or illness is a result of an employment-related activity. Okay? If you have a group plan at work and you get hurt on the job, your group plan at work is not paying for it. Your group plan at work would be referred to as a non-occupational policy because it's not going to cover you for it's only going to cover you for non-occupational illnesses and injuries. It's not going to cover you for occupational related illnesses and injuries. Listen to me again, a non-occupational policy will only pay for non-occupational illnesses and injuries. It does not pay for occupational illnesses and injuries because workers' comp provides those dollars. Okay, so workers' comp will pay if the injury or illness is a result of an employment-related event. Now, the worker cannot sue to get benefits. It's a guaranteed. The benefits are guaranteed by statute. Now, the employee might have to prove it was work-related, but once it's been established that it's work-related, the benefits flow automatically because of the law. So there's no need for the employee to prove that somebody was at fault. Now, workers' comp has 4 primary benefits. 1, medical benefit. And I have without limit. Now, there's always a limit, okay? But here's what they're driving at, or what I think you may watch for on a test. If I need a wrist brace because I've injured my wrist severely, they can't give me $25 and send me to Walmart to buy an ACE bandage. They have to provide whatever wrist brace is necessary without regard to cost to satisfy my problem. That's what they mean by without limit. There's an income benefit. There's a death benefit. And then there's a rehab benefit. And the only 2 that really seem to show up on a test at all are the first one and the last one. I've already discussed the first one with you, giving you some breakdown there. Let's talk about the last one. It is not required that workers' comp 100% rehabilitates someone, because it may not be possible. Some poor employee loses a limb. How the dickens are we going to get him 100% rehab? It's not possible. So watch for those two on the test. You may not even see it, but in case you do. Subrogation. Subrogation is a concept that says you can't collect twice. Let's assume you have, let's assume you don't have any auto insurance. And let's assume somebody hits you, it's their fault, and they don't have auto insurance. Well, you'd have to sue them to get money. That's the way it works. But if you have auto insurance and they don't, your insurance company is going to pay to fix your car, and then they're going to go after that person to try to recover their money. You are going to give up your right to sue that guy because you can't collect twice. That's subrogation. The insurance company seeks recovery for money it's paid. The insured subrogates or gives up their right to sue. You can't collect twice. That's the whole idea behind subrogation. Provisions, clauses, and riders. This is more likely one of the more heavily tested topics on the test. Provisions, clauses, and riders. We're going to get through this section, and then we're going to call it a day. Let me see where we are. We may not get through all of it. Yeah, we might. It depends. We're just going to work straight through. We'll see where we'll see where we are in the next half hour or so. But we're in good shape time-wise. There are mandatory provisions. Forget the page 31. You haven't got page 31 in the same way page 31 is in your book. Now, all of this stuff is in your text. If you want to dig it out, it's all there. But I'm not going through the text. It's there for you if you want to peek at it, okay? If you're flying on a plane somewhere and you want to read something, read the text. If you're on someplace where you don't have anything better to do and you're not near a computer, read the text. But if you're anywhere near a computer and an internet connection, get online and do the practice exams. That's where you ought to be, okay? So the mandatory provisions and optional provisions. The mandatory provisions are a result of a law. This law is called the Uniform Accident and Sickness Policy Provisions Law. It was a law that was started out as a model law. Let me go to my worksheet here. It's really a model law. By the National Association of Insurance Commissioners, affectionately referred to as the NAIC. 55 egomaniacs who run the various bureaus of insurance or departments of insurance in all those jurisdictions we talked about earlier today. And they all have different ideas on how to handle different problems, but they all have similar problems. So to maintain regulation of the insurance industry, what they do is they get together on a regular basis and they'll attack a problem they all have, and they'll come up with what is called a consensus. A consensus of opinion. There might be a C in there. I don't really care. And they'll create what's called a model law. And they take that model law and they bring it back to the legislatures of their states. The individual legislature of each state is who actually enacts or passes the law. Then it becomes a law in the state, not until the legislature does it. So this law, this Uniform Accident Sickness Policy Provisions Law, is the result of a model law developed by the NAIC to create some continuity and uniformity of laws across the country. There's not a great deal of difference. There is some, but not a great deal of difference in the laws affecting insurance from state to state, which is one of the reasons why you're going to be getting a Virginia health insurance producer license. That's what you're going to end up with. That license will allow you to get licensed as a non-resident in any other state without having to take their test because of this Uniform Accident and Policy Provisions Law. You will have a resident Virginia license, and you can get a non-resident license in any other state. There may be one exception, not important, without having to take a test. That's awesome. So what this law has done, it has defined the rights and duties of both the insurance company and the insured. Also, any of these provisions that we're going to talk about may be reworded by the insurance company, but they cannot make those provisions less favorable to the consumer than the original intent. For example, one of the provisions is this thing we called earlier the contestable period of 2 years. Well, insurance companies, if they want, can make that contestable period shorter to 1 year. They just can't make it longer, okay? Making it shorter would be better for the consumer. Making it longer would be less favorable to the consumer. They can't make it less favorable. Now, you don't need to know the number, but there's basically 24 of them. 13 mandatory, 11 optional. Let's get into them. The first one we're going to talk about is called the entire contract provision. And basically the entire contract provision deals with everything has to be in writing. If it's not in writing, it's not part of the contract. So what makes up the contract? Here is what makes up the contract. The policy, the application when attached. We mentioned that earlier today. And then any amendments, riders, or endorsements. These are changes to the contract. In other words, it has to be in writing. That's what makes up the entire contract. And no changes can be made. This should not be foreign to you if you've done any thinking at all about it. No changes can be made to a written contract without the written consent of both the company and the policy owner. Makes sense. Now, if a change is going to be made, here's where you may need to think it over. If a change is going to be made, who makes the change? There it is in front of you. Executive officer makes the change. Now, earlier today, we talked about changing the application. Don't confuse the two questions. Changing the application, the insured or the owner must sign it or initial it. They make the change, they initial it. But changing the contract, administrative officer of the company does that. Okay. Grace period. Now, grace period is not a period of time that you pray that they pay. It's got nothing to do with prayer. Grace period on health insurance, I think we covered this already, is determined by the mode of premium. We've already covered this. Somehow or other, it's a duplicate slide. That's part of the glitch I got to straighten out. 7, 10, or 31 days. Remember? Less frequently than monthly. 7 days, 31 days. We went over that. Nothing new. So grace period is one of the mandatory provisions. Reinstatement, we've also covered that. If a policy lapses by non-payment of premium, the policy can be reinstated. But what? Make application, prove you're insurable. The company has how many days? 45 days. We've already covered that. Now, when they reinstate the policy, here's why this is here, because I forgot. When the policy is reinstated, accidents are covered immediately. But sickness, 10 days. You remember that probationary period we talked about earlier? The 30-day probationary period on disability policies for sickness? Well, when you reinstate a disability policy, you have a new probationary period because they want to make sure you're not reinstating it because you're coming down with a disease. But you only have a 10-day probationary period for reinstated policies as opposed to a 30-day probationary period for new policies. That's the distinction here. Beneficiaries. Those traditional policies provide beneficiaries where the owner can name a beneficiary because the benefit is what? It's a reimbursement policy, huh? So the insurer is going to get the money. But in case the insured dies before the company pays the benefit, they have to be instructed as to who give the money to. That's called the beneficiary. So beneficiaries could be revocable, which is standard, or irrevocable. So revocable beneficiaries can be changed like the owner changes socks. They don't have to make any reason why. They just get rid of them. All they have to do is putting in writing to the insurance company, we're changing the beneficiary from Mary to John. Bang, it's done. Irrevocable beneficiary can only be changed with that person's written consent. So be careful. Irrevocable does not mean you can never get rid of them. Irrevocable does mean if you want to get rid of them, you must get their written permission. Okay? Don't worry about the rest. Now, those traditional policies that we talked about, remember, you go to a doc, you pay the bill, then you have to file a claim. Well, there's a process to file that claim. So there's some numbers and things you got to know. You got to notify the insurance company that you got a claim to be filed. So you got to notify. Why do they want to be notified? Well, they want the claim on a form that they want to see. They don't want you to write your claim down on the back of a napkin. So for them to get you a form that they want the claim put on, you have to notify them that you have a claim so that they can get you the form. So there's a process. So the first step in that process is to notify them of a claim. Notice of claim. You have to do it. Oops, I clicked over. You have to do it in writing, and you have to have it done within 20 days. Now, that number is important. You need to know that number. One way to remember that number is, what do you notice things with? Your eyes. What's perfect vision? 20/20. So think of it this way. Notice 20/20. Notice 20/20. One way to remember that. Notice 20/20. Once you notify them, then they have to get you a claim form within 15 days. Now, how are you going to remember that 15? Forms and 15 both begin with the letter F. So notice 20/20, forms 15. If they don't get you back a claim form in 15 days, you can put it on the back of a napkin, but I promise you they get you the claim form. Once you get the claim form, then you have to fill it out, and file what is called your proof of loss. And proof of loss must be submitted within 90 days of getting that claim form. And one way to remember it is, when you're done with all this, you're going to want to do 90 proof for 90 days, okay? 90 proof. So 3 numbers. If you see any of these questions on the test, they should just jump off the page. Notice is 20/20, forms 15, 90 proof. Now, once they get that proof of loss, they have to pay us. So that's how quickly. Answer, immediately. Simple. Now, you're going to find immediately doesn't mean you can be banging on that controller's door and expect to walk out of there with a check. You have to give them a reasonable period of time to cut the check. But there is a question, if you see it, and the answer is immediately. And disability benefits have to be paid at least monthly. Here we go with that no less frequently crap again, huh? So can they pay a disability benefit weekly? Yeah. Can they pay a disability benefit twice a month? Yeah. Can they pay a disability benefit quarterly? No, because paying it quarterly would be less frequently than 30 days. So they cannot pay less frequently. They can pay more, but not less. Payment of claims. Basically, who gets the money? Goes to the insured if they're alive. But remember, if the insured's dead, they would have named a beneficiary. Now, if there is no beneficiary, make a note. If there is no beneficiary, then it goes to the estate of the insured, not to the beneficiary's estate, the beneficiary to the estate of the insured. Estate is everything you own minus everything you owe. That's an imperfect definition, but it'll do for now. Everybody has an estate. Some people it's in the red, some people it's in the black, but everybody has an estate. So, payment of claims goes to the insured if they're alive. If they're not alive, it goes to a named beneficiary. If they're not alive, it's going to go to the estate of the insured. That's kind of how it goes. Don't worry about facility payment clause. Physical exams and autopsies. Insurance companies have a right to physical exams. They have a right to autopsies. If they want one, they got to pay for it. Okay? They have a right to physical exams and autopsies. Now, they don't generally do autopsies on a health insurance policy, but they might on a life policy. Some of these are interchangeable. Just know they can have them, but they have to pay for them. There might be an exception, and the one exception would be if a local or religious law forbids autopsies, then they can't do it. If a local or religious law forbids autopsies, then the insurance companies cannot do it. And they may never, ever, insurance companies may never, ever perform an autopsy unless they're dead. No autopsies allowed on live people. That's a poor attempt at humor. I don't think, some people don't think that's very funny. I do. Time limit on certain offenses. We've already talked about it. Remember the incontestable clause, right? 2 years. We have guaranteed renewable health policies, 2 years. We've already talked about that. By the way, 2 years is also a good answer for look-backs on pre-existing conditions. Now, if you don't, if you pay your premium, they got to pay. Remember we talked about, no, we didn't talk about unilateral, did we? We will in a minute. Legal actions. If they don't pay you, you can sue them. But you have to wait at least 60 days. Earlier we said they got to pay you immediately. Well, immediately means you got to at least give them a chance to cut the check, so you got to wait 60 days. If they haven't paid you within 60 days, you can sue them. But you better sue within 3 years, because Virginia has this 3-year statute of limitation on trying to sue to get benefits from an insurance company. So watch for that. I've already gone through this prorated cancellation and short-rated cancellation. Remember prorated? Forget that without prejudice. That shouldn't even be there. I'm going to get rid of it. But insurance companies, if they cancel the policy, they must provide a prorated refund of unearned premium. I went through the math on that. And if the insurer Ed cancels, then it's a short rate refund. I don't have that slide. I don't know why. Now, those are mostly mandatory provisions. Now, they're not going to ask you which one is number 1 or number 6 or number 8. Not going to ask you that. Just be familiar with the provision name, so to speak, and what does it mean. Now, optional provisions are there. The insurance company may or may not put them in the policy. But I can assure you, if you were an insurance company, you would put optional provisions in your policy because they protect the insurance company. Change of occupation provision. In health insurance, especially disability income insurance, occupation is a major factor in the underwriting. Librarians are going to pay less than steel workers because of the risk involved. So the general rule of thumb is, if somebody is a librarian when they buy the policy and then later become a race car driver, the insurance company is going to want to raise the premium, but they won't know it unless they're told. So this provision protects the insurance company against someone who changes their job from a less hazardous to a more hazardous job and doesn't tell them. Because if they do that, the insurance company will then adjust the benefit to pay the lower benefit using the premium against the more risky job. Change of occupation provision. But if they go from a more hazardous to a less hazardous and don't tell the insurance company, well, then they would get a prorated refund of unearned premium. Insurance companies not going to keep more than they're entitled to, nor do they want to pay out more than they're supposed to, okay? Anybody who changes their job from more to less hazardous and doesn't tell the insurance company, I call that stupid, because they're going to get a reduction in premium. But in case they don't, there's a provision to deal with that. It's called the change of occupation provision. We've already done misstatement of age or gender. Benefits adjusted would have been paid based upon the correct age or gender. Illegal occupation. In health insurance, illegal occupations are a factor. If we have a bank robber insured by our health insurance policy and he or she gets shot holding up a bank, we're not going to want to pay it. But if this provision is not in the policy, we got to pay it. Not we, the insurance company. So this provision will be in the policy because it provides that if the insured gets sick or hurt as the result of an illegal occupation, the company doesn't have to pay the claim. The insuring clause, they may want you to know, well, where is the insuring clause and what does it do? Well, the insuring clause is usually always on the, not usually, it's always on the first page. And what it does, it spells out who's insured, because they want to know the names of everybody that's insured under the contract. There's one exception to that rule. We'll cover it. But by and large, they want to know who the insured are. They're named insured, the name of the insurance company, and what's covered. Free look. The free look provision is in every health insurance policy. It begins from the date of delivery, which is why we needed what? The date on that policy delivery receipt. It's usually 10 days. However, long-term care policies and Medicare supplement policies, they give us a 30-day free look. Now, that's not free insurance. Be careful. It's not free insurance because you don't get to look unless you pay. Now, if something happens during the free look period, the policy will pay. But if the client turns the policy in during the free look period, the coverage is done. See, the free look period is to benefit the customer. Once they get the policy, they get a chance to look at it. And if there's anything they don't like, no matter how trivial it may be, they may return the policy to the insurance company and get all their money back, okay? They get a full refund of all dollars. Consideration clause is also on the first page. They usually combine it with the insuring clause because the consideration clause is going to basically spell out more detailed the customer's application and premium being the customer's consideration, and the company's promise to pay. It'll spell it out in more detail. We already talked about elimination period. Nothing new there, right? Elimination period is a deductible. It's how long you got to wait before your policy will begin to provide you some benefits. Now, waiver of premium. Unique provision under the policy. Waiver of premium. This provides that under certain circumstances, the premium doesn't have to be paid. What are those circumstances? This is what you'll need to know. If that insured becomes totally disabled. Now, I didn't say total and permanent. I just said total. There's a big difference between being in a body cast and losing a couple of limbs, okay? So body cast is total, but not necessarily permanent. So if somebody's totally disabled, the insurance company says, all right, but you've got waiver of premium. Oh, yeah? Well, what does that mean to me? Well, here's what it means. You got to make your payments for 3 months. Even though you're totally disabled, make your payments for 3 months. However, at the end of the 3 months, if you're still totally disabled, we're going to give you back the 3 months you paid us. It's kind of like a qualifying period. They want to make sure you're really totally disabled. At the end of the 3 months, they're going to give you back the premium you paid and waive your requirement to make any payments for as long as you're totally disabled. But there's a caveat. Be careful. Make sure you understand the caveat. The disability must occur prior to age 65. I didn't say that premiums will stop, a waiver will stop at 65. I said the disability must occur prior to 65. Be careful with that. Because there is no coverage under waiver premium if somebody is disabled at age 65 or older. Earlier today, we talked about recurrent. Remember, we talked about relapse. If a person has a disability, they're disabled, they go back to work, and then they have a relapse. If it's within 6 months, it's a continuation. If it's after 6 months, it's new. I hope you remember that we covered that. Residual is different. Residual kind of takes the place of what we used to call partial disability. Most companies no longer provide a benefit for partial disability because the problem was if you were partially disabled and earned any money, you lost your benefits. So it didn't make much sense. So they came up, they restructured the idea. So residual is more of a way benefits are paid as opposed to a type of disability. More like recurrent is a way benefits are paid as opposed to a type of disability. So residual, your benefit is going to be based upon the percentage of pre-disability income you have lost. So we're going to use the same example we used earlier. Guy's out for, or she's out with a heart attack, a year. Under this concept of residual, they have lost 100% of their pre-disability income, which means the policy is going to pay 100% of its benefit, or $3,000 a month. If after the year is up, he's feeling a little bit better and they go back to work part-time and they make $2,500 a month, the calculation now is they've lost 50% of their pre-disability income, which means the policy is going to pay 50% of its benefit. Instead of killing him, knocking him totally out of the box, he's still going to get 50% of his benefit. So here's what it looks like. When he was totally disabled, lost 100% of his income, policy paid 100% of its benefit. And in my example, that was $3,000. Went back to work part-time, made $2,500. That's half of his income. Policy pays half of his benefit. He got $2,500. Now he's got $4,000. His incentive here is what? Go back to work. With the residual benefit, it's go back to work. Because the sooner he goes back to work, the more money he makes. Kind of makes sense. It's a sliding scale, isn't it? I'm not sure, but I understand it. Welfare benefits don't work that way. If you make too much money, they just pull you off the benefits. They ought to make it a sliding scale, because I don't believe most people want to be on welfare forever. But that's not for this test. Coinsurance, stop loss, out-of-pocket maximum. We touched on these words a little earlier. Let's see how they work in a policy. Remember coinsurance. First, you pay your deductible. Then the company pays a larger of some percentage. Stop loss, as I told you. Once a bill hits a certain number, the company pays 100% beyond that. Out-of-pocket maximum is a calculation. Stop and think about this. If we know what a person's deductible is, we know what their coinsurance is, and if we know what the stop loss limit is, we can calculate exactly the maximum amount of money they would have to pay out of pocket in any loss. It's called out-of-pocket maximum. Maximum exposure for the insured. So let's see how it works. Let's create an example. John has a major medical policy, a $500 deductible, and a 80-20 coinsurance, $5,000 stop loss. The hospital bill is $3,000. How much will he pay? I'm going to give you the answer. The answer here is not as important as knowing how we got the answer, which is the value of doing those practice tests. Because knowing the answer is good, but it's also knowing how the answer, why the answer is the right answer as well. So it's $1,000. How do we get there? Well, first of all, in this question, the $5,000 is of no value because the bill was $3,000. So this is there to distract you. We're going to start with $3,000 because that's what the bill is. Whenever you should you get a question like this, by the way, you'll have a calculator. It'll either be a drop-down menu on the screen or some little calculator they got from the dollar store. You have to beat the hell out of to get to work, but you'll get some kind of calculator to do these silly math questions. And there may be 1 or 2 questions on the entire test, so it's not math-driven, I promise you. But anyway, how do we get to $1,000? Here's where we got there. The bill was $3,000, so you always take and start with what is the amount the insured is responsible to share in. So he shares in the bill up to the stop loss. Now, which in this case is $3,000. Subtract his deductible, multiply that answer by 20%, and add them back together. So don't forget to do it in the right order, and don't forget to add them back together. That's what he's paying, $1,000. Let's change it a little bit. Now the bill is $18,000. How much will he pay? The answer now is $1,400. Now stop loss is a factor because the bill is beyond $5,000. He's not paying anything beyond the $5,000 stop loss. So here's how it works. The bill was $18,000. Stop loss is $5,000. He only shares in the bill up to the stop loss. We start at $5,000. Subtract his deductible. Multiply it by this coinsurance. And then add them back together. This, by the way, also happens to work out to be his maximum out of pocket. That bill could go to $180,000 and he's never paying more than $1,400 in this example because of that stop loss limitation. Hope that makes sense to you. Coinsurance. We've already talked about coinsurance, so we're not going to go over that again. Deductibles. All right, deductibles. Health insurance deductibles take on a couple of different forms. They take on a couple of different forms. The most common deductible is called an annual deductible. An annual deductible. That means you must meet the deductible before the end of the year or it starts over again the next year. Then there's a per occurrence deductible. Works a lot like your auto insurance. Every time you have a wreck, you have a new deductible. Well, health insurance, same way. Every time a new event, got a new deductible. Family deductible, it's a break for large families. My mother was the oldest, as I said, of 21 children. If Grandpa had a $100 deductible on, that would mean he'd have $2,100 out of pocket before he could get anything paid for by the insurance company. He'd have gone broke. So it limits the deductible once 2 or 3 kids meet the deductible. So annual deductibles once a year, per occurrence, per occurrence. Family, they cap it after a few family members hit the deductible. Then we have that corridor deductible. Remember, we talked about corridor deductible. Supplemental major medical policies have corridor deductibles. Common accident deductible. 2 people insured by the same insurance company, don't know each other, but they're in a building that collapses. They both get injured in the same event, and their policy has a common accident provision. Insurance companies are going to only look for a maximum of 1 deductible between the 2 of them. Common accident. So annual deductible has a carryover provision. How does a carryover provision work? Any money spent towards a deductible in the last calendar quarter carries over to the new year. So let's make sure you know how that works, because you may get a question about it. Let's assume somebody has a $500 annual deductible, and they go to the doctor in June. They pay the doctor $100. They go to the doctor in October and pay another $100. And they go to the doctor in December, pay another $100. Cheap doctor. Well, and yet they have not met the deductible. Without the carryover provision, come January, they're back to $500 again. Well, that's kind of a bummer, because the guy's been relatively healthy and hasn't really used his policy. So the insurance company says, any money you spend in the last calendar quarter, we will let you roll that over to the new year, so that in the new year, we're going to give you credit for that $200 you paid in the last calendar quarter. So we're going to let you subtract the $200 you paid, and your deductible for the new year is going to be what? $300. I hope that makes sense to you. Carryover provision. Any money spent in the last calendar quarter carries over to the new year to help them meet that new year deductible. Carryover provision. Per occurrence deductible is a lot like your auto insurance, as we already said. Family deductible, that means the deductible will cap out and max after 2 or 3 members meet the deductible. Corridor, again, supplemental major medical, and we already talked about the common accident provision. Co-payments, remember, nothing more than set dollar amounts per medical service. It's kind of like your admission to get on a ride, huh? You got to pay the money before you can get in and see them. That's the way it works. Co-insurance is percentage. Co-payments are dollars. Exclusions are an insurance company's excuse not to pay. There are some exceptions to the exclusion. Maternity. Now, aside from the fact that the Affordable Care Act has changed all of this, the test doesn't care. Remember, the test doesn't always reflect reality. So maternity is optional for individual policy. It used to be when we had an individual apply for health insurance, we'd have to ask, is any insured currently pregnant? The answer, it was yes. You aren't covered for pregnancy under this thing. Oh, are you planning on getting pregnant? Well, no. Well, good, because if you get pregnant in the next year, we're not covering it. They had a longer waiting period for pregnancies. Well, they can't do that anymore. But on the test, this is where it goes. Maternity, optional for individual policies. You had to pay for it if you wanted it, but mandatory for group. So how would that work? Well, let's assume Mary is 3 months pregnant. She goes to work for a company that has group health insurance. That company has a 90-day probationary period. At the end of 90 days, she's now eligible for the group health insurance, and she's 6 months pregnant. They have to cover that pregnancy as if she was not pregnant when she got on the plan. They couldn't treat it as a pre-existing condition. So that's why we're talking about mandatory for group, optional for individual. Mental and emotional benefits and substance use benefits are generally very limited. They're never, ever the full amount of benefits. I don't ever remember seeing any questions about this on the test, but in case you do, I want you to know that. Now, anyone in the military? I don't know how somebody in the military is covered by a private policy, but it's a stupid question. If you get it, make sure you understand. If they happen to be in that circumstance, the private policy is not paying. Okay, that's military stuff. Excuse me, I'm sorry. Allergies are brutal. I guess you got them up there. Excuse me again. Woo. All right. Self-inflicted are always excluded. They're never going to pay for if you do it on purpose. It has to be accidental. I sell life insurance, and I tell my life insurance customers, see, in life insurance, there's this thing called the suicide clause. And the suicide clause basically says if you're going to commit suicide, you better wait 2 years. If you're willing to wait 2 years to commit suicide, once the policy's been in effect for 2 years, we'll pay your death benefit. Okay? So it'll pay the death benefit if the suicide occurs after 2 years. So I tell them, if you're willing to wait 2 years and you want to kill yourself, that's fine, but don't miss. Because if you miss and become a vegetable, your health insurance policy is not paying. So do your family a favor if you want to do something stupid and don't miss. Okay? And they laugh. Ha, 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 ha. Okay. Nobody's ever taken me up on it, but just so you understand. Self-inflicted is not covered. Dental, cosmetic, and refractions. Refractions referring to eye surgery. Now, there's an exception to dental, cosmetic, and refractions. If we need dental surgery, cosmetic surgery, or eye surgery because of a traumatic event, horrendous accident, scalding, whatever, policy will pay for that. But if you want that kind of surgery as an elective because you want to look better, the policy is not paying for it. So under dental, cosmetic, and refractions, you might make a note. Not for elective. I mean, it is only for elective. The exclusion is for elective surgery, not for surgery that is necessary because of a traumatic event. And then being cared for in a government facility is also excluded. The letters URC and UCR. The letters stand for usual, reasonable, and customary. Usual, reasonable, customary. It's a method to determine how much a health insurance policy is going to pay. Usual, reasonable, and customary. Sometimes they change it to usual, customary, and reasonable. Most health insurance policies have a schedule of benefits, like a menu, appendectomy, X, arm surgery, X, whatever it is. But a policy that pays a benefit based upon the usual and reasonable charges based upon the average charge in a given geographic area, that's a UCR policy. Payment is based upon the average charge. They're not looking at a schedule of benefits. Most policies have a schedule of benefits. Okay, there's a difference. The UCR policy usually costs more. Riders. We already talked about an impairment rider, huh? An impairment rider is a permanent exclusion. Now, disability income policies, we have this provision available. It's a rider available when a person buys their disability income policy. Not all companies do it, but some do. That says you may add this rider to the policy now, and if you want to increase your benefit later because your income has gone up, we'll let you do it, and you don't have to prove you're insurable. It's called the guaranteed insurability rider. It's also referred to as a future increase option. It's only under disability income policies. So what will happen? Every couple of years, the insured can apply to the insurance company for an increase in benefit without having to prove they're insurable, as long as their income has risen. So if I started out with a $3,000 benefit because I was making $5,000 a month, in 3 years, if my policy says 3 years, I can apply. If my income is now $10,000, I can increase my benefit to $6,000. I can keep the same proportion of income to benefit without having to prove I'm insurable. If I added this rider. If I don't add this rider, if I'm not insurable, I can't get it. Then we have what are called multiple indemnity riders. Multiple indemnity riders. These double or triple the benefit if by accident. There are some hospital indemnity policies, for example, that say, okay, you buy this policy and we'll pay you $100 a day or $200 a day, whatever it is, for every day you're in the hospital. But if you end up in the hospital because of an accident, we might double or triple that benefit. That's called a multiple indemnity rider. That's all it's about. Rights of renewability. Now, the test has changed a little bit, so we're only going to talk about what you need to know for the test. I want you to look at the third, fourth, the bottom three. The bottom three. 99.9% of all health insurance policies issued in Virginia are called guaranteed renewable. We've been through that already. That means the insurance company has guarantees that you can renew the policy. You don't have to prove you're insurable, but they could increase your premium. But remember, if they're going to increase premium, it can only be by class. They can't single you out. Guaranteed renewable. Some, very few, matter of fact, these are very rare, policies are non-cancelable. Guaranteed renewable. And the difference between the one and the one, this one and the one above it, is that non-cancelable, they can never increase the premium. Think of it, can never. Can never. Okay? Well, the premium is going to be higher to start with there than it would be under guaranteed renewable. And then we have another one called period of time insurance. Make a note, please. It's also referred to as blanket, B-L-A-N-K-E-T, blanket insurance. Earlier, we talked about the fact that the insuring clause wanted to know who are the named insureds. I said every insurance policy wants to know who are the named insured, but there's one exception to that rule, where here it is. I want you to visualize this. If we took a room full of people and we covered everybody in that room under a blanket, and we looked down on that blanket, everybody would be covered. We just wouldn't know who's who. There's no individual identification. Well, that's the idea here. A blanket policy, there's no individual identification of each insured. No need to name every person. But it's term. It can't be renewed. It's only going to be for a certain period of time. Schools use these when they take kids out on field trips. If I was a scoutmaster, I'd want to take a bunch of kids out on a camping trip. I'd want to get a policy like this in case one of those kids gets sick or hurt on a trip. I don't want the parents to sue my butt. So I'd go to a company that sells this stuff, and here's what they would ask me. Here's the underwriting process. They'd say, okay, where are you going? When you coming back? Approximately how many you're going? Great. Here's your premium. That's it. All they care about is when are we going, when are we coming back, and approximately how many you're going. They don't care who, because at the end of the trip, the policy's over. Whoever goes is covered, because I don't know who's going to show up that Saturday morning. I hope you're getting the idea. Period of time insurance, also referred to as blanket insurance. So with that, we're going to call it a day. We're going to pick up with social insurance tomorrow. Hold on a minute. I got to go off the air for just a quick 10 seconds. Hold on. My allergies required that I blow my nose, and I certainly didn't want to do that into the microphone. All right, now, question. I have a question for whoever's there on the management team. Is everybody coming into the office tomorrow, or are they not? Anybody answer me? Does anybody know? Nobody knows. All right. Well, you all make that decision. What I'm going to do, I'm going to send out an email to management. Oh, Eric, what's happening? I'm sorry, Eric, whoever's in Richmond.
Oh, Richmond, Tracy.
Yes, sir.
Hey, yeah, we coming back. He coming back in the office tomorrow in here.
Okay, so I'm going to assume that the others must be doing the same. Okay.
We coming back in the office.
All right, so the rest of the way. Okay, so I'll send out a message to Chris, and he'll pass that out to everybody. And we'll start tomorrow morning about 8 o'clock. We'll pick up with social insurance. We'll cover the law, and we'll be done. So it'll be rock'em sock'em.
I think Lynchburg is going to be a little different. I think we were told to not come to the office.
All right. Well, can you ask whoever's in charge to let me
Okay.
know what the decisions are. And here's what matter of fact, here's what I'm going to do. I'll make it easy. I'm going to send everybody an email with the login credentials for the webinar tomorrow. If your management team says come to the office, go to the office. If they say stay home, you can access on your computer at home. I don't care. I just don't want to get in the middle of what your decisions are. But I certainly want to make sure whoever is you're all of it, it can get on, you know. If there are any issues or mix-ups, everyone has my phone number. Call me with questions offline, and we'll get it straightened out. Fair enough?
Fair enough.
Great. All right. Well, you guys, it's been a great pleasure having you today with all the interruptions. Things went well. God bless you. You drive safely. And we'll catch up with you guys tomorrow morning right around 8 o'clock. Watch for the emails. Some of you did not get my emails. So there's a number of things I'm going to be sending out. So just be alert. If you don't get anything from me, let me know. I probably have your wrong email. Okay?
Hey, so in that email, this
Yeah.
is Richmond Tracy, and that email is going to have that thing for the test, practice test, is what you're going to send me?
Oh, yeah. I'm going to send a couple of things. I'm going to send out your credentials for the practice of a license coach. I'm going to send out the email with the code for getting onto the webinar tomorrow in case you don't go into your office. And there may be one or two other things, and probably another email as well. All right?
Okay. Yeah, thank you, then.
If you don't get it, call me.
All right, thanks.
All right, guys. God bless you. Be safe.